the LME in London.
Exactly.
On copper. What a move.
What a move. And to put this in perspective, John, the velocity from 10,000 to 10,700 has literally been days.
Pricing through a demand shock, in a word to Jeff Curry. But Jeff also pointing something out that I think is interesting on the iron ore side, Tom, just quickly.
Please.
Demand in China, and I think this is really interesting for copper too, demand in China has not been as robust as you would expect if we're going to talk about a super cycle. He's also talking about a pullback in supply. What's happening with steel right now because of this environmental transition. And I think that's the big change in 2021 compared to maybe years gone by. We're talking about this huge environmental transition on top of a demand boom too, which underpins some of that as well. So the traditional cyclical read that you might get from copper is a little bit distorted this time around, given the political environment that we're in at the moment.
Yeah, the clear message of 2021 being different from 2002 from Mr. Curry at Goldman Sachs, and that has always been a consistent theme with Ian Bremmer of Eurasia Group, whose books are too many to mention. I can pick one of them, one of their titles, and say it is also about this moment. We welcome Dr. Bremmer this morning as we speak of every nation for itself. Dr. Bremmer, once again, food dynamics. Rice in Cambodia really matters. Rice in America, less so. What is the food dynamic that you observe of this commodity lift?
Just tells me that the gap between rich and poor countries on the back of the pandemic and the rebound from the pandemic is being felt so greatly differently. You know, this is that you already have before the pandemic, you had about a quarter, for example, of everyone in Yemen being food stressed, not being able to have enough to eat. In Sudan, numbers are similar. Those numbers are doubling on the back of the pandemic right now. One of the most disheartening statistics that was indirect from the pandemic was the fact that we had an increase of about 50 million of extreme poor people around the world. The first time that number's gone up in well over in generations. I think it's like 40 years since that number's increased year on year. That's you know, that means food insecurity. That's first and foremost the most important thing. It's going to be that hit. And you're going to see that play out in so many of these countries where these prices have gone up and the governments don't have any capacity to provide support.
Ian, I'm sure you saw Ramachandra Guha's magnificent essay in the FT, I'm going to say 10 days ago, about the collapse of his India. Do you at Eurasia Group look at this pandemic and the horrific news from India as being politically and Eurasia Group destabilizing for the region?
It's not destabilizing inside India. You know, I mean, India's Prime Minister Modi, despite having incredibly badly mishandled the last wave of this crisis, is still you know, the popularity base that he had was higher coming in than that of any other major leader. So he has a long way to go before you talk about domestic instability. Domestic opposition would have a long way to strengthen before they could be cohesive and really pose a challenge to him. But there's no question that when you see the India variant spreading as much as it is across Southeast Asia now, when you see the fact that the Indians, who have been the largest producers of vaccines around the world, and now they have massive shortages inside their own country, they've had to suspend all export. Most of that export was going to other countries in the region. So this is now where the broader epicenter of coronavirus crisis is. It's India, but it's also South and Southeast Asia. It's also the region that's going to have some of the least capacity to actually fight it. And by the way, the India-based and Chinese-based vaccines aren't as effective as the mRNA vaccines. I mean, I saw some extremely disturbing news. I don't know if you noticed this from the Seychelles. Seychelles has had more vaccine rollout than any other country in the world for their small population. They now also have more human-to-human spread per capita in cases, new cases, than India. That's astonishing, and that's because most of the vaccines are coming from China, and they don't have the efficacy in stopping spread. That's, again, a serious problem for the developing world. Right now largely isn't about Moderna and Pfizer, which has much more efficacy. So yeah, I'm actually quite worried about what this is going to look like over the coming months.
How the West can help, that's the big question right now. And I've got to say, the answer to that question is showing some real division between Europe and the United States at the moment. The US, as you know, Ian, tried to suspend IP protection, at least trying to push that issue through the WTO. And then you've got Europe turning around and saying, well, we don't think that's going to help. Germany's looking at the United States for hoarding vaccines and not exporting them. What did you make of the US decision last week, Ian, without bringing the allies on board? Because this is playing out quite publicly, and it did so through the weekend.
Yeah, this is playing out publicly. But, you know, the funny thing, first of all, I mean, the German response that this is not the way to actually provide help in the near term, that's true. I mean, it would take a very long time. We're talking about not just weeks or months where there's urgent need right now, but a year or more to get the kind of manufacturing capacity that would be aligned with just opening up the patent. So it's important symbolically for a lot of progressives in the Democratic Party, and Biden will benefit from that. But this isn't what's going to move the needle for the problem that we just talked about. The big issue is that here's the Biden administration trying to do the right thing and not coordinating with allies in advance. That's the mistake. It feels just like the announcement to leave Afghanistan. I mean, when your allies are absolutely critical, you shouldn't be in a position where the German government, where the EU is caught blindsided by you saying you're going to suspend IP protection. The Americans, in talking about helping the rest of the world in terms of this pandemic, we need to be talking in advance of our announcements with all of the key allies. It's such an easy thing to do. The Biden team should be good at this. This is where they're falling down.
Begs the question, Ian, why aren't they?
I think because they're used to these are experienced men and women that have been around foreign policy establishment for decades. And for them, you know, multilateralism means the United States does the right thing and other allies just go along with us. It doesn't mean that we actually might be wrong or might have to compromise, because we've been in a position of such strength and because the alliance itself has been so much more cohesive. That's not as true today. Part of that has been 4 years of the Trump administration, but part of that is just Europe itself is moving in a different direction. They're feeling of their social contract, their feeling of the effectiveness of their representative democracy just is different than that of the United States right now. And I think we're living that experience.
Dr. Bremer, your top risks of 2021, you have been out front in saying we have to pay attention to cyber. You talk about a cyber tipping point in January, and here we are talking about it for real with this pipeline across the nation. Give us an update on the tipping point you see.
Yeah, I mean, the funny thing is, I don't think the tipping point is between the U.S. and Russia, between the U.S. and China, because there is a level of deterrence on cyber attacks between those countries. We do espionage against them. They do espionage against us. We use the data in ways that are useful for us, but we don't break things. We don't go in and destroy critical infrastructure. We don't take the kind of actions that could precipitate a kinetic response, a hot war, where the problem is that unlike nukes, where you had that nuclear balance, but those were only the only countries that had that capacity in the Cold War. In the case of cyber, you know, we stopped the Iranians from developing nukes. We're trying to get back into a deal to do that. We haven't stopped them from developing some of the world's most effective offensive cyber capabilities. Criminal networks in Russia, in Eastern Europe, in the United States, around the world have incredibly sophisticated cyber capacity to destroy things. And we see that with the smash and grab, both on the data of this critical pipeline over the weekend, but also in the ransomware attack to shut them down. And you know, we just don't have cyber defenses to deal with this. I'm particularly worried that they were going to shut down hospitals in the middle of vaccine rollout. You know, in the early days, that was something they were clearly capable of doing, these criminal networks, and thankfully for us, they didn't. But the vulnerability is massive.
Ian, it's good to catch up, as always. Ian Bremer, Eurasia Group President and Founder. And Tom, for anyone outside of America not familiar with the Colonial Pipeline, we're talking about 2.5 million barrels of fuel a day going through that pipeline. I think it's almost 40–50% of fuel. Gasoline fuel demand in this country on the East Coast, provided by that pipeline.
It's been out there forever, and there's pipelines all across the nation. But John, what it comes down to is to look at price. And on the Bloomberg We did see not a surge, but a lift in oil and certainly a lift in key gasoline as well. John, another chart I'm looking at, and this goes directly to your property, the real yield. This is the belly of the curve, the 5-year inflation-adjusted yield. You go back 20 years. For those of you on Bloomberg Radio, all you got to know is from Paul Volcker, it's been a straight line down to a massive and new, ever worse negative yield. John, it speaks volumes.
Yeah, and the nominal's been pretty stable with the exception of Friday, of course. The nominal's stable, Tom. Inflation expectations picking up, real yield even lower. And every story we're discussing at the moment, whether it's the colonial pipeline, whether it's the labor market, whatever it is, we're talking about a supply-side response. And the way to address the issue is high prices.
Yeah, Liz Ann Saunders has that out this morning nicely on Twitter, the idea of the supply versus the demand for labor. And, the JOLT survey, Mike McKee loves a JOLT survey. That will be fascinating. And, John, if you want a reaffirmation of 10% GDP, we've got retail sales on Friday.
JOLT's tomorrow. I'm going to show the 5-year chart of JOLT's a little bit later in the program.
Are we?
Quite a chart. I'm going to do that. I'll bring you that chart. And we'll talk about the employment to population ratio too. I'll bring that chart to the table as well. What's in store for Bloomberg surveillance through the next couple of hours?
It's just
what a lineup.
When do we talk about the Dodgers losing 5 series in a row?
We can do that right now. What's happening with the Red Sox?
The Red Sox are looking, they're good for May.
Mets still getting it done?
They're getting it done.
Do we discuss the Yankees or do we not even talk about the Yankees?
The Yankees are putting it on.
They're putting it on.
It's very close. Yeah, they started weak. And they're coming back. And the West Coast is what I'm looking at, John. I swear the players want to live on the West Coast. Why is San Francisco, LA,
that's true of football.
San Diego, Seattle?
They want to live in Barcelona. They want to live in Madrid.
Really? I didn't know that.
Yeah.
How about those Tots?
How about them? How you getting on?
Yeah, what a disgrace.
Coming up, we're out for time. Let's get it together, Tom. Joshua Sharfstein at Johns Hopkins Bloomberg School of Health. A little bit later, this is Bloomberg.
I like Dogecoin. I really like Doge.
With the First Word News, I'm Ritika Gupta. Crude oil and gasoline rose after a cyber attack put the largest oil products pipeline in the U.S. out of action. Colonial Pipeline still hasn't come up with a timeline for restarting operations. Fuel suppliers are concerned there could be a shortage of gasoline and diesel across the eastern U.S. In Jerusalem, weeks of violence threaten to escalate on the day Israel celebrates its control over the contested city. Palestinians clashed with Israeli police and at least 50 Palestinians were hospitalized. Israel is marking the anniversary of the day. In 1967, it captured Jerusalem's eastern sector from Jordan. And the use of Dogecoin has reached new heights. The cryptocurrency that started as a joke has now been used to pay for a lunar satellite launch. Elon Musk's rocket company SpaceX will embark on a journey to the moon next year, carrying a mini satellite that's been paid for in Dogecoin. No word on what that satellite would cost. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The CDC has been saying all along that it is very likely that we're undercounting. The model says that it's a significant amount, as you mentioned correctly, 900,000. That's a bit more than I would have thought the undercounting was. But, sometimes the models are right on line. Sometimes they're a bit off. But I think there's no doubt, Chuck, that we are and have been undercounting.
Dr. Fauci speaking to NBC over the weekend from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Here's the Monday morning price action. All-time highs on the S&P 500. We advance another 1/10 of 1%, 42.28 on the S&P 500. Euro dollar advancing just a little bit at 121.71. Dollar weaker through March of G10. Top of the pile, sterling and the Aussie. The Aussie advancing off the back of a huge move in the commodity market. Iron ore futures absolutely surging. Copper, that rally continues. A record-breaking rally.
Yeah.
And WTI, crude, Tom, 65.23, up a half of 1%.
There's a number of proxies on commodities. Just an easy one is loonie. Dollar Canada, and that was a 124. It's now down to 121, and we had a strong Canada 120 earlier this morning. Just one of the tea leaves you can look at to measure commodities. We at Surveillance, John and I are scrupulous. I say scrupulous about corrections. A viewer, a listener emails in named Alarian, and he makes clear, don't forget the Mets.
Five-game winning streak, is that right? A 5-game winning streak,
Yeah, well, it's great. What Alarian's doing is he's pals with Steve Cohen, and he's trying to become what we call, John, first base coach.
What does that mean?
You go out and you stand on the field. I can see Alarian out there in the Mets uniform standing next to first base. And then
you tell them whether they should run to second or not.
Sort of like that.
Kind of what you do?
It's not like it's a token job title for someone, but I can see Alarian talking to Steve Cohen.
You're calling that a token job?
No, but
I
can
should
see
have a token job as first base coach.
Trust me, John, he would take it. He would take it if he could get it. Let us move on, and thank you to Dr. Alarian for watching and listening this morning. This is a really important conversation. Your emotion about the pandemic on a domestic basis. On this Monday, we look at America. Joshua Sharfstein joins with Johns Hopkins Bloomberg School of Health as Vice Dean. Joshua, I want to get back to first principles in America, which is simply the clumsiness of being partially vaccinated. How do we prosecute May, June, and July partially vaccinated? What's your advice?
Well, one very important strategy is to keep vaccinating, to switch from large stadiums to smaller venues, to take vaccine to people, to keep pushing, the rock up the hill so that we get more and more people vaccinated. You're asking for individuals. What can individuals do?
Do we not wear a mask? Do we berate people that haven't been vaccinated? What do we do about airlines? What do we do about the kids in camp or their kids going back to school? There seems to be a stew of items as we're partially vaccinated.
Well, you're right, because there's a lot of virus out there. There's still 40,000 cases a day in the United States. We can get that number way down with greater numbers of people vaccinated. So that leads to a lot of judgment calls in these different areas. I'll tell you, Myself, I don't wear a mask outside, but I will wear one if I'm going inside. I will certainly hang out with my parents without a mask because we're all vaccinated, but I'm a little nervous if I'm around like a lot of people and I don't know their vaccination status. That'll change though as more and more people are vaccinated and the numbers of cases go down. But everyone's going to have to make their own decision. I think summer camps are probably going to be in much better position, especially if they can do some testing for kids before they get there and they, are very careful when kids are there. But until, we really get the numbers down, we're going to be in this sort of virus purgatory.
Joshua, you said there something interesting. Everyone has to make their own decision, but that's not the case now at all. In fact, we all have to face these ridiculous requirements when we go inside a restaurant to eat. We sit down, we converse, we take our masks off, even when the waitress or waiting staff comes to the table. The barman, for instance, another case, you'd have the mask off. But when you stand up and go to the restroom, you must put the mask on. It's as if people believe that when you walk into the restaurant, COVID-19 knows and you better have a mask on, but when you sit down, it goes away. And when you stand up to go to the restroom, it'll follow you. Don't you find some of these restrictions a little bit ridiculous now?
I think it's a good idea for us to try to rationalize these. In a lot of places, eating indoors, going to a bar indoors, it's not the safest thing at all. And in fact, it could quite lead to another super spreader event if there are people around who aren't vaccinated. So I think we're struggling a little bit with our, anxiety about, having people show that they're vaccinated. Hopefully that will dissipate and we'll be able to have more clear rules, which might look like people who are vaccinated can go to, restaurants without a problem. And other people do have to put up with, either using their judgment not to go, which I might recommend in some cases, or having different requirements.
Well, let's talk about some of the numbers at the moment on the vaccine front. This was in the New York Times. I'm sure many of our audience have read the piece. Wisconsin officials have now asked for just 8% of the 162,680 doses the federal government had set aside for the state next week. That was according to the AP. In Iowa, officials asked for just 29% of the state's allocated doses. And in Illinois, the state is planning to request just 9% of its allocated doses for everywhere except for Chicago. This also coming from the AP. Joshua, what underpins that? What's going on?
Well, at some point, we're going to get to the moment when the excess demand is being met. And we're switching from, trying to capture the excess demand to trying to help people make a decision to be vaccinated. In a lot of places, that's the point we're at. And that means we're not going to be filling large stadiums anymore with people getting vaccinated, but it does not mean that we should just be throwing up our hands and deciding, we're never going to reach herd immunity, whatever that is, and there's nothing more to be done. There is so much more to be done, particularly in reaching out to people, answering their questions, getting them vaccine in convenient ways, getting it into their doctor's offices. There's so many opportunities to keep vaccinating, and we really have to sustain that idea. It's not just about whether someone wakes up in the morning and is going to, climb a mountain, run through the forest to get vaccinated. It's that they go to the doctor and the vaccine is there for them.
Joshua, good to catch up. Good to see you. Joshua Chastain there, the Johns Hopkins Bloomberg School of Health Vice Dean. Just a headline crossing the Bloomberg, Tom, in the last couple of moments. Stiefel offering analysts a $10,000 appreciation bonus. That coming from some reporting a little bit earlier this morning. UBS, of course, paying a $40,000 one-time bonus to its global banking analysts. You're seeing more and more of this, aren't you?
Well, we're seeing it on Wall Street, what we care about, but it's permeating the American economy. John, there's no question about this. I hear it anecdotally every step of the way. Labor has the upper hand for the first time in ages, and you're seeing this, and it's just to keep the bodies there. Obviously, they're picking out the good bodies and all that, but we're going to see a lot more of this.
Are we going to see it in next month's payrolls report, do you think, given what we just saw this last Friday?
I think it's a very elite thing. Right now, I'm not sure it's in next month's payroll report. I'll leave that to the market economists, particularly those that have been humbled. But, John, I would suggest it's, again, that inequality and the fight for the haves to get the labor.
Coming up, Jared Woodard of Bank of America. He'll weigh in on this situation. Looking forward to that debate, that conversation in around about 10 minutes' time. Equity futures this morning, unchanged on the S&P 500, all-time highs.
We got
Your
through
yield,
the hour without Lisa.
157.19. Can we do the next hour? Will we get by? Lisa back in about a week's time.
I think Doge looks...
Dogecoin next.
Doge.
Yeah.
renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There's been an enormous buildup of savings and a lot of pent-up demand. So I think you're going to see really strong growth.
We should all recognize that the economy right now is experiencing a demand shock, the likes of which we haven't seen since World War II.
Not any one single report is going to determine the Fed's change or its projections.
You don't want to start tightening up monetary policy and then find out later when you tried to battle low inflation for so long that you jumped to the gun.
The data is important, but it's really the data not right now. It's going to be the data in August, September, when we can say that the reopening is behind us.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It's Payrolls Monday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz will be back with us next Monday. Your equity market with just a little bit of a lift on the S&P 500. Your bond market, 157 on 10s, Tom. The round trip from Friday. The conversation continues this Monday. Your lower Friday session, 146.43. Right now, 157.
Well, more than I've ever seen, and the conversation continues. After the history made on Friday, John, the jobs report still front and center. Lots of good research work on it. There's any number of ways to look at it, but it goes right on to this coming Friday, where we see retail sales, which many suggest will reaffirm the supply boom that we're seeing.
Could see a deceleration month on month, which will give some fuel to that whole peak growth debate. But whatever the conundrum, the dilemma you're looking at the moment, whether it's the labor supply story, whether it's the colonial pipeline, we can address many of these issues with what? Higher prices. And what do you see in the commodity market this morning? Higher prices. Iron ore, absolutely ripping. Copper, absolutely ripping. WTI right now, 65 handle, Tom.
Yeah, commodities are really front and center this morning. It's something we've done some good work on. Jeff Curry with Francine here earlier this morning with Goldman Sachs, and he reaffirmed that this trend is in place and moving higher. John, I like what you've said about iron ore, which is quoted in Shanghai, in Singapore, I believe down in Australia as well. And iron ore is sort of the China commodity that really indicates this boom.
The Aussie doing nicely as well in the FX market.
Canada
the Aussie
too.
dollar firmer by 0.5%. Cable, Tom, up by 0.8%.
That's where I wanted to go, yeah.
Through 140.
Yeah, that surprises me. Cable 138.39, and all of a sudden we pop up three big figures, 141, even 142 here in the last number of minutes. A lot of nuances in the litmus paper of the global system. But John, in the yield space, just as importantly, that dynamic between longer-term yields, what they did, and shorter-term yields, what they did not do, to me is key.
The Fed going nowhere anytime soon.
Yep.
In your equity market, we look like this: 42.29 on the S&P 500. In the bond market, yields 157, coming in almost a basis point now. Crude 65.19 on WTI. We advance 0.5%. Euro dollar 121.64. It's unchanged on the day, but 121.64. You mentioned this over the last couple of weeks, Tom. When does the noise really start? 122? 123?
Sooner than we think.
Yeah?
I think people were humbled the last time around. There was a lot of 130, 125. Stronger euro, folks. What does that mean for the Europe export juggernaut?
Let's bring in Jared Woodard, shall we? Bank of America Securities Head of Research Investment Committee. Can we just start with the supply side at the moment, Jared? Whether it's the colonial pipeline and the issues there, we can solve them with higher prices if you want to import some gasoline from Europe. If it's the labor market shortage, you can hire, put up wages. What are you seeing, that dynamic on the supply side? Can it all be addressed with higher prices?
Well, some of it can be addressed, and not all of it. I mean, semiconductors is the big one, I think, that's affected even the labor market possibly in that latest report. And semis is going to take a little while to sort out as far as we can tell. But it's also not, a sort of catastrophe. But most of the big headlines, whether it's in commodities or in labor, we think can be addressed with higher prices, higher wages, it's kind of a two-period market. I think everyone's ready, and I think properly should be strapped in for what could be a very wild summer. But if we look ahead 6 months, we look to the end of the year, we expect fairly normal conditions, even inflation back down to levels that were more consistent with what we saw before the pandemic.
Sign-on bonuses, transitory. Jared, you've made this point that the conversation Tom and I were having earlier this morning, 10 minutes ago, on the labor market, Stiefel offering an appreciation bonus, UBS for certain bankers getting a bonus if they get a promotion. That is all discretionary spending, Jared, in terms of just the extra bonus. It's not base salary. And Jared, I just wonder from your perspective whether that plays into the Fed's hands a little bit on the labor market, that on either end of the wage spectrum, we're talking about bonuses and we're not talking about higher base.
Yeah, this is exactly what the Fed wants. I think if you're worried about long-term wage price spiral, I think you can relax a little bit here, because a signing bonus is not a raise. Whether it's $50 to show up for a McDonald's job interview, or
that's what I got.
10,000 or 40. Yeah, then I mean, or at the high end, these higher bonuses at the high end, these are not permanent salary increases. If they were, that's a different conversation. But so far, there's no evidence of anything persistent, because employers and workers both understand that, again, 6 to 9 months from now, things are probably going to be a lot more normal than we expect.
Yeah, John, it was great. Al from New Jersey sent me a $50 check and said, "Be sure there's change left over."
How did you get on at McDonald's?
I don't know. It was great.
I can't imagine you at McDonald's.
Number 2 value meal and coffee.
That's you eating at McDonald's.
I went large. I got the extra large fries just to get me through the day. Jared, you have a single sentence in your note that's just so important and really wise. You got to have the courage to buy inflation surge when there's no inflation. But then what do you do when inflation expectations finally go? What do you do when the expectations of inflation are finally there? Do you sell?
Well, look, let's look a little bit of history. Okay, our economists expect, I think, 3.6% CPI this quarter. I think that's exactly right. And if you look at what's happened in the past, when we've seen inflation surges above, say, 3.5%, just the past 30 years, there's been quite a few of those occasions. We looked at market impact, market data around those prints. And if you bought all the inflation trades, the commodities, Europe versus US, et cetera, on those occasions, past 30 years, on average, 1 year later, your inflation trades lost money. Now, so to me, that says that if you believe the inflation trade now, is something you have to buy when it's already priced into the market, some of those trades have already done really well, then you've got to be convinced that this is the big one. And we just don't see any evidence of that. Instead, we think investors still have to keep a kind of a balanced approach. Within the inflation trades, within the reflation trades, we still like financials very much. But I think that the commodities, the materials, the energy, there's just not enough evidence on that side. And if you do see more dips, more corrections even in the tech and the growth kind of trades, for a long-term investor, those have to be viable opportunities.
Jared, what do you think of the FANGs? David Costin's at the Death Star, Goldman Sachs, making a big splash this weekend on valuation of the FANGs. Do you agree that the FANGs actually offer value given their growth characteristics versus the 10-year yield?
I think they're trading vehicles, perhaps they're almost kind of like a macro expression of what's going to happen with growth and inflation, but they're not. I don't think people are looking at them as deep value by any means. If you like the sort of the tech and growth type stocks, I think small and mid caps are more attractive here.
Jared, caught up with Rick Reeder at BlackRock a couple of days ago on Friday, and he was talking about running a higher cash position across some of the portfolios, something in the double digits, mid-teens maybe. Jared, does that make sense going into the summer to have that dry powder?
I think it does make sense to have some cash ready to deploy. If it's a question of something tactical to be ready if there's some big dislocations. On either end, we could see overheated reflation trades that you want to sell to go rotate back into growth. You could see the reverse where we get another bad jobs print and people start to really get gloomy. Either case, you want to have cash ready. I don't think it's a good moment to be sort of allocating higher permanent portfolio positions into cash or anything else that's going to change your fundamental mix, because right now there's so many cross currents. You can roll the dice and any analyst can tell you any number of 10 different things. When there's that much confusion in the market, that much confusion in the labor data, I don't think it's a good time to make permanent decisions.
Just quickly though, Jared, what would fund that position? Would you trim broadly or somewhere specific?
Well, I would trade some of the mega cap stocks, whether it's tech or otherwise. My colleague Savita Subramanian's, I think, been fairly neutral on some of the mega cap stocks for a while, and at the bank we're much more favorable on small and mid caps. So I think that the trades that have already done very well, the really liquid names, are the obvious places to look for cash. And that can even include investment grade credit for multi-asset portfolios. We're kind of bearish on that part of the credit market and see better opportunities elsewhere.
Hey, Jared, good to see you. Great to catch up on a range of issues. Jared Woodard there, Bank of America Securities Head of Research Investment Committee. Go on, Tom.
I just wish more people had Jared Woodard's on their staff. I just think he does the best job in the street of trying to think about legitimate asset allocation.
Key issues.
And sector weighting. To your question on cash I know people, John, who've literally lost their jobs because they had a prospective mandate of X% cash and they insisted on going more. Literally with kids' tuition, they lost their jobs. Put up the banner, if you would, year to date. On radio, it's real simple. Standard & Poor's for John up 13%. The Dow does better, John, up 14%. NASDAQ trails 7% year to date. John, that's not a bear market. It's so much gloom.
I should have bought that single Dow ETF, shouldn't I?
You should have. Dow futures up 113.
13%. Tom, I'm looking at cable right now. Sterling with a 141 handle on the pound. I think at one point last year.
What is that? Does that mean you leave me and move back to London again?
Not just yet. I think we've got to talk about the political side of this trade as well,
Please.
which is really boosting sterling. The Prime Minister did okay in the last week. Won a by-election, the Conservative Party did.
Oh, come on.
In Scotland, just quickly, in Scotland, the SNP did not get their big majority that they wanted to push forward this Scottish referendum, and that's underpinning this bid this morning.
The Telegraph gives them lots of love, ex-employees, same political bent and that. But, John, the rest of the newspaper zeitgeist, it's not that they're in love with Boris, but they're saying, look, he delivered, right?
Don't be surprised if they start pushing for another election pretty soon.
Who's they, the Conservatives?
Yeah, I know we have this Fixed-Term Parliament Act, but there's ways around that.
How did Labour do? I mean, how did Sir Keir do here? With this, I mean, is he out of a job?
He's not out of a job yet, Tom.
Right.
But others have been. Sir Keir Starmer's struggling here. He's got to make this count. How does he stand out? And he was offering a more moderate view for this Labour Party against the aggressively progressive left-wing view
John,
of Mr. Corbyn.
How can you not play Gareth Bale this weekend?
I don't know. I didn't watch the game, Tom.
You didn't watch the game.
I was watching my dear AC Milan,
who should coach
which I never
the Tots?
mentioned. Why do you think I'm mentioning AC Milan right now? 3-0 against Juventus.
They beat Juventus 3-0.
3-0, getting it done.
Folks, you learn so much
to qualify for the Champions League. We'll read you some football scores sometime.
We should get Maria Tadeo in here, and she can cover Barcelona.
Maria, to be fair, would probably save our football coverage, to be honest with you. 42-29 on the S&P from New York City this morning. Good morning. This is Bloomberg.
First Word News, I'm Rishka Gupta. There's still no timeline for restarting a giant fuel pipeline in the U.S. that was knocked out by a cyber attack. The Colonial Pipeline facility is a critical source of supply for the New York region. Fuel suppliers are growing increasingly nervous about the possibility of gasoline and diesel shortages in the eastern U.S. No word on who's responsible. U.S. Infectious Diseases Chief Anthony Fauci says there's no doubt the country has undercounted the number of coronavirus deaths, but Fauci told NBC News that a University of Washington analysis saying the true toll is probably over 900,000 is a bit more than he would have thought. The official number of COVID deaths in the U.S. is at 581,000. Prime Minister Boris Johnson confirmed that the next stage of lockdown easing in England will go ahead on May 17th as planned. People will be allowed to stay overnight with friends or relations, and indoor hospitality will be reopened last week. The government said limited international travel will also resume then. And UBS will pay a $40,000 bonus to its global banking analysts when they are promoted. That's double what some competitors are offering. Banks are trying to reward and retain younger employees worn down by a surge in business. Starting as soon as this month, UBS will pay the bonus to analysts promoted to associates. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax
in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
On Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Later this month, we're going to be distributing the first tranche of the state and local assistance from the American Rescue Plan. We won't get all 1.6 million of those jobs back in 1 month, but you're going to start seeing those jobs in state and local workers coming back.
The President of the United States, Joe Biden, from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa will be back with us next Monday. Here's the price action this Monday. 42.29 on the S&P 500. We advance 0.1% on the S&P. Yields unchanged at 157.54. Euro dollar 120.165. The excitement in foreign exchange is elsewhere. Cable sterling against the US dollar 141. Top of the pile, a stronger pound. We advance on that currency pair, Tom, by 0.9%.
Let's stop right here quickly, John. What do you see in foreign exchange? To me, besides dollar weakness, it's a renminbi really breaking out to new Chinese strength. What do you see?
Sterling strength is a domestic political story in the UK, particularly in Scotland. The Aussie reflecting that better story in the commodity market. Aussie stronger this morning, Tom. Iron ore doing better, copper doing better. We're really moving, surging in some parts of that commodity market.
For those of you not wired into this, we educate the Australian dollar wired into not only the Pacific Rim, Aussie yen, Aussie Sing dollar, obviously Aussie renminbi and iron ore, but also, John, the polarity between Australia and Canada dollar can show you some information.
Crude, the story for Canada. Crude's doing okay, isn't it? 65.31 on WTI.
And importantly, with the pipeline, the Colonial Pipeline cyber issue, it really hasn't surged all that much. But nevertheless, Brent crude in the vicinity of $70 a barrel. Let's get to Washington right now on radio and television. We welcome all of you across this nation. Emily Wilkins with us. Emily, I want to go to the reality. We all know the convention, Senate close, and that. Connor Lamb, now northwestern Pittsburgh suburbs. He had to switch districts with reallocation or whatever, excuse me. Connor Lamb won 49.86% to 49.53%. He's out of a job if Joe Biden screws this up, right?
He and many other Democrats. I mean, look, remember, during midterms, things are usually better for the party that is not sitting in the White House. So that's point one for the Republicans. Point two for the Republicans is that this redistricting is again happens every 10 years. And who controls more of the state houses? Republicans do. And so who's more likely to win the House in 2022? It's Republicans. And so that means Connor Lamb, that means Jared Golden, that means Alyssa Slotkin. Michigan, Ohio, Illinois, all of these lawmakers, they have a lot on the line here.
And they're all going to get together and sit on a couch. What's the difference between the sitting on the couch and the Oval Office? Well, John, is it Wednesday? I can't remember.
It is Wednesday, the
Wednesday,
big four
okay,
in the
fine.
White House.
What's different than that than what we saw with President Trump, Speaker Pelosi, and Mr. Schumer?
Well, President Biden would like you to think that the key ingredient is him, that he does have the experience of working in the Senate, that he has a track record of working in a bipartisan manner. And there are advantages, right, to Democrats getting together and finding a bipartisan path forward. There's certainly a group of Americans that want to see that happen. At the same point, Democrats don't want to give up so much in negotiations that they wind up presenting what they feel is an insufficient package to the American people. Remember, they might be under pressure from moderates, but they're also under pressure from progressives who are going to be trying to flex their muscle here to get what they want in the package.
Looking at the jobs report on Friday, the overwhelming response that Tom and I had from economists was don't be too hasty, don't draw too many conclusions. What were the conclusions being drawn? What are the conclusions being drawn down in Washington?
Depends if you're a Democrat or you're a Republican. If you're a Democrat, this jobs report means that there are too many people who are worried about returning to the labor market. They have fears about catching coronavirus. They can't do it because of childcare, because of schools. If you're a Republican, this means that the federal government has done way too much to help those who are currently unemployed, giving too much money. I mean, Jonathan, we've talked about this before. You've seen Montana, you've seen South Carolina, and now you're seeing Arkansas go ahead and revoke that supplemental unemployment benefits with the idea that the less money is being given to those who are unemployed, the more individuals who will be returning to the workforce.
The worry, more will follow, Tom, and maybe prematurely, because validating the Democratic position at the moment, at least, was the female participation rate, which really, I think, reveals a story that childcare is a massive issue right now still, Emily, in this labour market. That participation rate on Friday actually dropped. Do you think this is a state-to-state decision that is specific with the data? Because I'm hesitant to make too many generalizations across the country. The unemployment rate right now in Montana is 3.8%. It's clearly very, very low. For others to follow, are you hearing a political argument or an economic one?
I think there's a little bit of both going on here, right? I mean, for Democrats to say, hey, more is needed for childcare, that plays right into that proposal from President Biden seeking to increase, or rather decrease, the price of childcare and make it easier and more affordable. So I think there's a little bit of both going on here. And I think to your point earlier, there is some truism to the fact that this is just one jobs report and that we are going to have to see what the next month and the next month looks like. Remember, we're not going to be seeing any sort of big legislative proposal from Congress soon. And so all of those job reports, I think, are going to be playing into the Washington rhetoric.
Emily, is there any kind of cogent plan on cyber? I don't observe one. Is there any theme, theory, bipartisan agreement on cyber?
There is a bipartisan push to get something done on cyber attacks. Look, both Democrats and Republicans realize that hacks like the one we've seen on the Colonial Pipeline and a number of others over recent years are a huge issue. The question is what can be done. When Congress tried to do legislation in 2012, it got really strong pushback from lobbyists saying the things that Congress wanted to implement would be too expensive for businesses to do. The question is now we are 9 years down the road, is there more momentum in getting something done? Another big question, what can be done through that infrastructure package? President Biden's plan does not specifically mention cybersecurity, but we've already heard from lawmakers that sit on committees like Yvette Clarke, who is the chair of the subcommittee on cybersecurity, that she's going to be working on getting cybersecurity measures into that infrastructure plan.
Emily, thank you. Emily Wilkins, Bloomberg government reporter down in D.C. Tom, Marty Schenker mentioned the same thing about an hour ago on that infrastructure package, and maybe that'll be part of the conversation this coming Wednesday.
Well, we'll have to see. I mean, the conversation Wednesday is important, but I'm going to go back to that banner. For those of you on radio, I put up the 2 digits here, how Connor Lamb barely won the rejiggered congressional seat in Pennsylvania. John, I really sensed a difference this weekend. We are really becoming completely political, maybe the advent of the primary season for Republicans and Democrats.
What aspect of the weekend do you think became more political?
What I think became more political is just the reality of how close it is, how it is President Biden and everybody else is essentially equal status, whether it's the House. So, you know, we saw the 2 House districts drift away, 10 days ago? And that changes the math.
We're doing big things on slim margins. And there's a belief around Washington, I think, that there's going to be some big pushback next year.
And that's not true in England, right? I mean, it's a whole different field there.
Very, very different. Coming up, Ben Emmons, Medley Global Advisors, Managing Director of Global Macro Strategy. Equities up 3 on the S&P. We advance 1/10%. Yields 157.72. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. With futures positive, this is Bloomberg Surveillance.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio. And here's your Monday morning price action. Your equity market 42.29. On the S&P, we advanced 4 points and up about 0.1%. A little bit softer on the Nasdaq, down about 1/3% there. The Russell off by about 0.6%. Switch up the board and get to the bond market. 2s, 10s, and 30s. We'll discuss the commodity market in just a moment. Romain's going to run you through some of the mining stories, the metal story, iron ore, copper. Take your pick in commodities at the moment. Absolutely surging and reflective of the consensus view in this market post payrolls that we don't have a demand problem. What we have is a supply shortage. In the bond market, what did that mean? It meant a gap lower on a 10-year yield to 146 and then a bounce, so rip back almost straight away. 157.90 on a 10-year is your yield right now on a 30-year at 228.46. I'm going to get there. It's in here. 14 basis points. Let me get there. The point of this, Tom, is that I complete my thought and then you come back.
Oh, is that how we do it?
Just TV and radio works perfectly. 14 basis points on a 2-year. That tells you a story, Tom, of a Fed that's not going to go anywhere for a long time.
John, that's how I was channeling you. That's where I want to go.
I know.
John, a 0.1429, folks, is an itty-bitty, teensy-weensy move on the 2-year. But, John, that is a huge signal to Jerome Powell.
And Chair Powell is with you. Why? Because I'm going to finish on this, Tom. You'll like this. Switch up the board. It is a chart, for those of you on radio, of the employment to population ratio. Get back to 61.5. That's the goal.
Yeah.
Right now, 57.9. Tom, that doesn't get it done. There's more work to be done.
Inside dynamics there, and I thought there's some really good social economics over the weekend on women struggling to get back to the workforce, John. Child care is not the dominant issue, but child care is a real issue to what we saw on Friday.
It's clearly a factor. You see it in the participation rate. You saw that on Friday in the female participation rate. Right now, your 5-year chart of the employment to population ratio, I will tweet that out on Twitter for you if you can't see it. If you can't see it, it reads 57.9, and before it was 61.5. Doesn't this work beautifully, Tom?
It's just
this relationship.
It's just, it's just poetry.
It's just wonderful, isn't it? When's Lisa back? Next Monday?
Why are we in a hermetically sealed distance,
I've got no idea. Why do we have a sheet of glass between us? You're fully vaccinated, I am too.
John's like 2 cities away
I think they just know that if we are in the same room, something's going to happen, especially without Lisa here.
Yeah, that's probably true.
I don't think
Let's
we
have
want to
Romain
test that.
save us.
Romain's going to save us right now. Morning, Romain.
Good morning, Tom and John. Well, of course, let's talk about that commodity space because that's what everyone's talking about. I mean, Tracy Galloway.
Romain, stop.
Yeah.
For radio, Romaine is channeling Elon Musk. Okay, we can continue.
Okay, thank you, Tom. I think he's referring to the way I'm dressed. So, but for those of you who can't see that, what we do have on the board here is what's happening here in the commodity space. I mean, look, last night, Tracy Alloway emailed me, basically said, right as I was going to bed, and said, have you seen iron ore prices? You saw that 10% pop on iron ore. Of course, you've seen copper continue past those record highs today. Not a whole lot of ways to play that here in the U.S. Freeport-McMoran, obviously the biggest publicly traded mining company here in the U.S. Cleveland-Cliffs, of course, a beneficiary from the iron ore perspective. Both of those names up 3% here in the pre-market. And of course, all the talk is about that Colonial Pipeline shutdown and whether it's going to reopen, how long that lasts, and whether this persists will be a big dictator here of where gasoline prices go. Right now, they're still hovering on average just below $3 a gallon. So not necessarily out of whack, but there is some concern if this goes on for another 2 or 3 days, you could start to see the average creep up nationwide up to 4. Of course, if you're out in California, you're already dealing with $5 and $6 a gallon there. Valero Energy here, one of the beneficiaries, that share is up about 0.6%. And Tom and John, I want to bring your attention to a couple interesting downgrades that happened this morning. The first one is interesting. This is on Facebook and Alphabet. It was a dual downgrade today. We're basically talking about this idea that digital ad spending and some of the optimism around it is just way, way too far out there. You're seeing Facebook shares lower by about 1%, Alphabet as well. The analysts there are really just saying, look, you have to kind of peel back the layers here and say that some of the surge that some of these companies have seen in that digital ad space, that was temporary, transitory, if you will, and that's not going to persist over the next 2 or 3 quarters.
Thank you for saying transitory. Romaine, does it also have to do with Tim Cook and the new Apple software?
I don't think
blocking out digital ad?
Well, it could be. He did not, the analyst in this particular case did not mention that in his note, but of course we do know that that big rollout, and in fact, if you have an iPhone, you've already seen those alerts already. I got one this morning. Kind of interesting to see how advertisers deal with that.
Romaine, thank you so much. To close this afternoon as well, 87% of earnings in, according to some of the research we saw over the weekend. Let's go to Ben Emmons, Medley Global Advisors here on the bigger macro picture. I want to go back to John after that. There's lots of good things to talk about here. Ben Emmons, what I saw is that we got to get to June 16th, the next Fed meeting, and we're going to do it without anything we ever learned in the textbooks. How original are the days to June 16th for this Fed? None of this is in the books, right?
None of it's in the books, Tom, and good morning. And so we are in a phase of where we have to work out this massive wrinkle that we're in this data currently. And the jobs report on Friday was one of those examples. Big expectations comes out differently, really, because we're dealing with such a shift in the data from last year. So if you go into the June meeting, presumably all the Fed members will look at, we're making progress here, no doubt, right? It's clearly we're accelerating with the economy. But I don't think you can use the traditional monetary analysis here. You still have to just gauge on what is this data really telling us. Can we draw a line from one data point to the other? I think what Neil Kaskari said on your show on Friday was quite clear. Basically, the jobs report vindicated their views. They have to see all this data come in first before they can make an assessment to make the next step in policy.
I look, Ben, at the new accepted policy, and as we said, they're making it up as they go. What will you watch for then in retail sales on Friday? It's market data about 70% of the American economy.
It's an important point, Tom, because if you think about where we are with spending and income currently, you look really at the metrics, even though there's a wrinkle in the data. I mean, we essentially made back pre-COVID levels on both fronts, and we have all the savings on the sideline. So it translates into this view that retail sales will be again exploding, so to speak, because not only are people out there, but there's this pent-up power to spend. But as you also point out, there's this, gasoline price issue that we're dealing with currently, right? So it would be interesting to see how the gas station sales are evolving from here, because that could actually affect it negatively in that particular report on Friday.
Ben, given what we saw on Friday, how sensitive or not do you think this market's going to be to incoming data in the weeks to come?
There's still sensitivity, John, because if you think about what happened on Friday with all this anticipation, this reaction was interesting, right? How it responded actually positive to a big miss on payroll versus expectations. I haven't seen that much before. So I think you can take that as a gauge on other points going from here, other data points. The market too wants to draw a line between strong data points and to say, okay, there's really this progress. So I think this is the ongoing I guess, trial and error every day to try to figure out where is the economy precisely from a year ago, because we made a lot back, but have we made it all back? And I think this is what's in the market's mind currently. Looks to me that we're in an economy where we are going to hit probably back to pre-COVID trends by this summer, really, because we've put the stimulus that we put in the system has been that effective that spending and income are back to pre-COVID levels.
Do you think the data's forecastable in the next month or so? Ben, the reason I ask that, I think we do have to reflect on the size, the magnitude of that miss on Friday. We all gauge stronger demand. You see that everywhere you look in this economy. We seem to have terrible difficulty right now understanding whether supply can meet it.
Yeah, that's true, John. Like, if as an economist, this is tough to do. I run a little model on just the leisure component for the payrolls report, and just regressing it against, payroll trends and ISM. Gave me like a 400,000 job gain for leisure, and it came out at 331 on Friday. So I thought, okay, great. But if you think about that type of analysis and other data points, you do deal with distortions, right? So I think the forecast itself, partly I think there's probably a bit of like a hope and expectations in there, like a hype, if you will, on what this big number the next big number could be. Whereas maybe more rational economists would say, like, look, we got to think of real trends here. Is the trend of the economy back to the trend of 2019, yes or no, and forecast it that way. I think for markets, for traders and portfolio managers, I just take data point to data point to try to gauge on what risk is. Ultimately, the bond market, I think, is the better signal for what this data says. And the bond market says the economy is hot, but there's also points of slowdown or, say, cooling off ahead of us because of these particular shortages.
Ben Smart, as always. Ben Emmons there of Medley Global Advisors. You know how this works. If you get a data point you don't understand, you talk about the 3-month average, Tom. Just take the 3-month average.
Unfortunately, John,
that's what we were doing on Friday.
True. That's way more true, folks, than anybody wants to admit. There's a real validity, particularly with inventories and such, to look at 3-month moving averages. John, I thought the David Costin note, I know Zero Hedge wrote it up, but it really was all across Wall Street over the weekend. And John, what was so important about the Goldman Sachs research, it wasn't the revenue chit-chat. It wasn't even the free cash flow chit-chat. David went much more in deep to where I was off Amazon's earnings of the investment these FANGs are putting into America. They summit at $250 billion in 12 months.
They're doubling down and securing their dominance. That
Absolutely.
has been the story the last 12 months, Tom. They've been the individuals, the companies with the money to do it.
Yeah, Amazon with 80 billion some, and the others follow up. And there's a difference in share buyback and non-share buyback and dividend. But John, this is a social issue. You wonder, it's got to become a political issue, almost like Ida Tarbell and Standard Oil of another time and place.
It already is in a massive way. Let's be clear about that, in a huge way. Looking at the data, JOLTS tomorrow, CPI coming up on Wednesday, PPI Thursday, retail sales Friday.
Yeah.
Where's your focus?
My focus, Citigroup just published moments ago saying core CPI really matters on Wednesday. John, which inflation data should we look at? I think that's a question.
It depends where your interest lies. If it's what the Fed's going to do, or rather not do, then it's PCE, isn't it? If it's CPI at the moment, look, here's the estimate, 3.6% year on year. You strip out food and energy, Tom, year on year, 2.3. That's a big move lower, isn't it? Stripping out food and energy.
John, it doesn't work on radio, but am I doing a good Elon Musk here?
That's a good Elon. Can you explain to people on radio what an Elon is?
Elon was on Saturday Night Live, and he went with the bow tie look like Romaine had and I have. And
do you think he was inspired by you?
No, I don't think so.
On your view on Bitcoin
no.
and
I don't know which handlers.
Dogecoin. Why don't we call it Dogecoin? Why is it Dogecoin? Why is it that?
I don't know, but can we be clear here? Am I right? It's just a project?
These are huge issues, aren't they, that we need to discuss through the morning.
58,000.
Matt Brill's not going to discuss that. 8 a.m. Eastern Time, Invesco head of North American Investment Grade. Looking forward to that. Yields 158 on 10s.
5-year tips.
Your equity market 42.27, unchanged on the S&P 500, the euro, and a 10-year. The price action elsewhere. We'll talk about that in a moment. On radio, on TV. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Crude oil and gasoline rose after a cyber attack put the largest oil products pipeline in the U.S. out of action. Colonial Pipeline still hasn't come up with a timeline for restarting operations. Fuel suppliers are concerned there could be a shortage of gasoline and diesel across the eastern U.S. President Biden is preparing for his first face-to-face meeting with Republican leaders Mitch McConnell and Kevin McCarthy. Wednesday's meeting comes as Republicans are ramping up their opposition to the president's $4 trillion economic plan. There's not much expectation for a breakthrough at the meeting. Last week, McConnell said he is 100% focused on blocking Biden's agenda. In Jerusalem, weeks of violence threatened to escalate on the day Israel celebrates its control over the contested city. Palestinians clashed with Israeli police and at least 50 Palestinians were hospitalized. Israel is marking the anniversary of the day in 1967. It captured Jerusalem's eastern sector from Jordan. In the UK, Labour Party leader Keir Starmer has revamped his team of ministers in waiting following disastrous election results. The main opposition party lost key battlegrounds to Prime Minister Boris Johnson's ruling Conservatives. Starmer says Labour must be the party that embraces the demand for change. And the use of Dogecoin has reached new heights. The cryptocurrency that started off as a joke has now been used to pay for a lunar satellite launch. Elon Musk's rocket company, SpaceX, will embark on a journey to the moon next year, carrying a mini satellite that's been paid for in Dogecoin. No word on what that satellite will cost. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season. Exclusive conversation. Dallas Fed President Robert Kaplan joins Balance of Power live at noon Eastern on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
What is Dogecoin?
Well, it actually started as a joke based on an internet meme, but now it's taken off in a very real way.
This is $1, right? It's real.
Sort of.
Yeah,
Sort of
okay.
real. Yeah.
So what is Dogecoin?
Well, it's the future of currency. It's an unstoppable financial vehicle that's going to take over the world.
I get that, but what is it, man?
I keep telling you, it's a cryptocurrency you can trade for conventional money.
Oh, so it's a hustle.
Yeah, it's a hustle.
Elon Musk on Saturday Night Live from New York City this morning. Good morning, alongside Tom Keene. I'm Jonathan Ferro. Lisa will be back with us next Monday. Your equity market looks like this on the S&P 500. Equity futures, 42.27. We advance a couple of points, up not even 0.1%. Yields, what a round trip we saw in Friday's session this morning, 157.72. In the FX market, euro dollar, bit of a snooze, 121.65. Cable, sterling through 141. Gets your attention this morning. The pound outperforming in the currency market. And in the commodity market, Tom, just briefly, crude, WTI, 65.50, up a couple of tenths of 1%, almost 1 percentage point for that matter.
With the commodity move, what we see in foreign exchange, we'll get to that in a moment. Right, Michael McGlone joins us, Bloomberg Intelligence here on, I guess it's a commodity because it's like a currency under the Bloomberg terminal, Bitcoin, 58,300. Dogecoin is not on the terminal, right?
Not yet. It might be.
What's the why there?
Well, it's a joke. It's a hustle for now. But it's now the number 4 cryptocurrency in CoinMarketCap.com. So to get to the next level, it has to make a major leap. So it's probably somewhat peaked.
I'm going to waste one more question on this tomfoolery. Musk there having his moment, doing the celebrity thing. How many people will be damaged by this? Somebody's got to lose in these transactions, right, at some point?
When it goes down, and I didn't say if, it's a matter of time. Yeah, it's a matter of time. But I think
what's funny about this?
Well, it's not funny when people lose money, but most people are taking it like, I've gone to Vegas, I might lose $1,000, but to me that's what it is. It's on a global scale, 24/7. People are treating it more like a gambling stock. It's just fun. And
Mike,
it's the meme.
Forgive me for ending the fun right now because we have to lean on you for your expertise in other parts of the commodity market. What's happening with gasoline, and what did we learn over the weekend about this pipeline, the Colonial Pipeline that's shut down, knocked offline?
I view what happened with the pipeline in a way it's a good thing because we're seeing small attacks. And this is obviously a big one, but if there's going to be a big attack in U.S. infrastructure, this is just making us stronger. Let's be aware of this. Let's make, now we know this is potentially a problem, that there's nefarious entities out there that want to attack our infrastructure. The key way to look at it is, what does it do for supply and demand of crude oil? Nothing. In fact, because prices will spike in the short term, because of retail and the delivery point, it's going to reduce demand. So to me, this is also an indication of, and people say, well, okay, I don't have to drive to work today. I'll just work from home. So it's a whole different world. But to me, the big picture is you're talking about petroleum versus building materials. I fully expect crude oil to continue to underperform things like copper and iron ore and stuff because we just have more of it. We don't need it as much anymore.
Is the supply response a little bit more nimble as well in the energy market, Mike?
Well, that's the key thing. Supply elasticity in crude oil and things like corn is definitely on the rise, yet demand elasticity isn't. So I fully expect supply to come in. I don't know why people really expect shale to not come back. If you look at the average cost of crude oil in 2019 was 57. Now it's at 63, 64. And, I mean, they can make money.
Mike, this is why we love to have you on rather than Elon Musk, because I was actually writing a banner here for us on the elasticities of gasoline, because you're pro and we know you know what you're talking about. What's the elasticity here for the politicians of $5 a barrel? I remember, John, sitting in a bar in Los Angeles.
I love how you're laughing because every story you've got involves a bar somewhere.
This is a few years ago. It was the first time I saw $3 a gallon as well. And are we going to see new highs that become a political maelstrom?
Unlikely, but Tom, it really brought back memories of 2008. I remember Per gallon gasoline went up above $4, and right after that, everything collapsed. That was near the peak.
Because price went up, demand went down?
Yes, exactly. And now we're in this stage now, like, okay, I was going to drive to work today. I'll just work from home. I can't get gas. It doesn't matter. I just plug in, log in my laptop, which is right next to my bed. I don't have to do that anymore. So it's a whole different world. But it brought back memories of that. We had that spike in crude oil, and then everything collapsed. So to me, for commodities that keep going up, metals are probably the place to be, but they need a higher stock market. If the stock market starts going down, the whole thing just collapses.
Mike, you've brought up a really good point just there. Let's build on that. What's speculative about what we're seeing, and what is just demand and supply clearing at spot? What's the difference here? Where do you look for the speculative activity?
I'm seeing, too, a little bit of speculative excesses in the grains and in crude oil, particularly crude oil, because people are thinking, oh, commodity super cycle, invest in crude oil. Well, you have to deal with contango eventually. You have to roll when you're looking at something that's going away. The best place, I think, to invest in long term, if you're looking for commodity super cycle, is metals, copper, aluminum, nickel, zinc, gold, silver, platinum, palladium. And you just can't invest in iron ore because there's no liquid futures.
The super cycle issue that I really struggle with at the moment, Mike, is China's participation in it. I'm really struggling to get a read on it all. The other thing I struggle with, let's get it all out there, all my thoughts right now. Traditionally getting a cyclical read from things like copper. Now I'm wondering whether what I'm seeing is just part of the energy transition. Yeah. Can you help fill in some of the gaps there, Mike?
Exactly what's happening. We're replacing energy, petroleum, with metals and technology. Definitely copper's on that demand side. The key thing is it's at the highest correlation ever to the stock market, 40 quarters.
So you're going to take the commodity movement right now over to, say, a multi-decade shift in how we consume energy.
Oh, yeah, absolutely. But 10 years from now, 1/5 of automobiles in China now are EVs. 10 years from now in this country, at least 5 years, average EV is going to be lower cost than the average internal combustion. And that's just normal economics. That's without all these incentives. Now we have this major push from the new the new Biden administration that's going to accelerate these trends that were in place before. But here's one key statistic I'll leave you with. Liquid fuel production or consumption in this country is exactly the same at 20 million barrels. It's a little bit less than it was 20 years ago. And that was before EVs really took off. Wow. It's the efficiency that's kicking in.
Can you see John Farrow in a VW Rabbit? A Rabbit diesel?
Remember
I can see him tooling around. And that Carl Weinberg's watching. He appeared with us earlier. Dr. Weinberg, John Farrow, says it's real simple. Blue-collar workers can't work from home. Bill Dudley told me that decades ago at Goldman Sachs.
Mike. Thank you, sir. Mike McClone of Bloomberg Intelligence. That final point is a worthy one. Should we also tell the audience, Tom, that you and I don't drive? Neither of us have a driving
license. No, but I think there's a lot, Mike brings up a really important
some people know that already.
There's a whole zip code-centric thing here.
It's very much a city living thing, isn't it? That you don't need to drive.
It is, but we forget it's a big nation, and it will become I don't know, $4, $5 a gallon. It's going to become a huge political issue.
What do you make of that energy transition issue? Just that piece of the puzzle that we take a cyclical signal from some of these commodity markets in a way that maybe it's been distorted now.
I'm going to listen to guys like Jurgen, Morse, Curry, and the rest. I'm not going to mouth off about it. I really want to hear what Dan Jurgen says in my book of the year last year, The New Era.
Matt Brill's going to join us next from Invesco. We'll continue this conversation from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro.
Did we cover Man City, Chelsea?
We haven't done that.
Jeez,
did you watch some of that?
No, I did not.
Chelsea's
I was watching
doing okay.
Red Sox.
I actually watched a little bit of that. Chelsea turning things around.
Yeah, they are.
Frank Lampard clearly wasn't a very good manager, was he?
No, I didn't. The spirit wasn't.
Your assessment.
He'd be perfect for the Tots.
He'd be great on this show too. From New York City, this is Bloomberg
Frank Lampard
Surveillance.
and the Tots.
Frank joining us next on TV and radio.
of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. Fur and burners.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
People were too optimistic. I think people, saw the big growth in demand, and they said, aha, supply is going to spool up to meet it, and it didn't.
Everyone's ready, and I think properly should be strapped in for what could be a very wild summer.
Not any one single report is going to determine the Fed's change or its projections.
You don't want to start tightening up monetary policy and then find out later when you tried to battle low inflation for so long that you jumped to the gun.
The data is important, but it's really the data not right now. It's going to be the data in August, September, when we can say that the reopening is behind us.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on TV, a simulcast on a Monday that is not normal. Abramowitz off for, I think, 1 week, 2 week, whatever. It's the Abramowitz sabbatical, and she's taking it right now. John Farrow, we've got to look at a Monday. Usually after a jobs report, it's boring. This morning is not boring.
Oh, anything but. We've had this story through earnings. We've had this story through payrolls Friday and into payrolls Monday. We've got huge demand. Can we meet it with supply? Whether it's the autos and the chip shortages, whether it's the labour market, the huge demand, and the labour shortage right now, it's a theme that keeps coming back to us again and again and again. And the solution to that theme in various parts, not so much the chip shortage, but in the labour market, will we deliver higher wages to fix that gap?
Well, we will, and it's a job dynamics as well as the heart of the story, obviously off of the great miss of Friday. John, I look at everything out there, and I've got to go to the litmus paper of the system. Renminbi stronger, DXY breaking down, Steve Englander writing about a new, weaker dollar, and you see it away from commodities. In sterling, John, sterling launches 139 to 141, 142. I wonder if Farrow will move back to London.
Well, it's not moving back to London. The ultimate trade, Tom, is getting paid in sterling over the next several months, and then changing it back to dollars every
see.
month and living here. That's the ultimate trade. The thing that I'm focused on, Tom, and I know you are too, 10-year real yields, negative 94 basis points right now.
Yes.
We come in again.
Yeah, the 10-year yield is what we usually quote, folks. Less obscure, I should say more obscure, is the 5-year inflation-adjusted yield. And, John, that breaks down to new weakness, a greater negative yield.
Do you think that's biting into the dollar this morning? Do you think it's part of the move?
I think it's part of the move. I think it's correlated. But, John, explain right now to radio and TV, explain the short yield market. We're going to go to the data check right now. John, explain the short yield market versus a long yield market.
So 10's clearly on Friday. The consensus view is that we don't have a demand problem. So we gapped lower initially, then we bounced back. We're back to 158. I think reflecting that story, the 2-year just sat there. Even came in a little bit, 14, 15 basis points. That's this idea that the Fed's not going to go anywhere for a long time, and the recent data validates that patience. And as you said, Tom, Chairman Powell probably feeling pretty good about himself after payrolls on Friday.
Well, we'll have to readjust to June 16th, and we have data this week. John, to me, inflation data on Wednesday is trumped by the retail data on Friday.
And we look at that month on month, so bear that in mind. There's going to be some real deceleration from the boom month we saw in a previous one.
Let's get to it. Matt Brill with us. We welcome all of you. He's with Invesco, Senior Portfolio Manager, Head of U.S. Investment Grade. This is not, let's say, think Priya Misra, full faith and credit, but investment grade, the corporate stuff out there. The whole thing has been a search for cash, record low yields, issue paper. The party's finally stopped, Matt Brill, hasn't it?
Hey, good morning. Yeah, the party on the issuance side has stopped a little bit. We're seeing less companies needing to borrow less money, but the party on the demand side is still there. And what we're seeing is the inflows coming in from overseas, hedging costs are low, and as the Fed stays low on interest rates or at 0%, that's going to continue to keep hedging costs very, very cheap for foreigners. So that's not going anywhere. We're also seeing just overall the Fed being accommodative. That just was completely reinforced with Friday's number. The Fed is going to be accommodative. That's good for risk assets. That's good for investment grade credit.
It's a different story, Matt Brill, but in 2006, pre-crisis, people were looking for itty-bitty basis point improvements to justify their thinking, their theory, or their need. Are we back to that silliness?
So I would say on the demand side, we're getting close to that silliness where individuals are searching more and reaching more and more for yield. The good thing that we're not seeing that we saw back in 2006, 2007 is corporations doing silly things and corporations reaching for additional leverage in order to juice their stock prices. So we're seeing a much more prudent action out of corporations, meaning that fundamentals are a lot better. But I do have some concerns that investors overall are beginning to be lulled to sleep and being brought out of their risk comfort zone.
See that in the supply story in high yield too, Matt, that a lot of the debt coming to market is for refinancing. It's good for the debt. We've seen the credit rally. But when you talk about triple Cs, and TK, I don't know if you've seen this, but triple C credit at one point last week was yielding 570, 572. And when we're talking about high yield, we're no longer talking about high, Matt. And if you've got to go all the way down the spectrum of credit quality to pick up 6% in triple Cs in America, does that make you nervous, Matt?
Yeah, a little bit. I think there's certainly individual credits that have a good trajectory in terms of we talk about triple Cs, but in a year they're likely to be a single B. But and that gives me some comfort there. But generally, that's not the area that we like right now. What we like is double Bs. And while the yields there are not necessarily great, the total return opportunity there actually looks pretty good. Because as you go from double B to triple B, you get upgraded, and then the larger buyer base can now start to buy you. The Japanese and the Taiwanese can now buy you once you become triple B, and your 4% yield goes to 3%. So it goes from low to lower, but you get that impact of total return. So I actually think you can make more in double Bs than you can make in triple Cs right now, and you can sleep at night in the time being.
Just getting some information on a new deal you might be interested in, Matt. It's an Amazon offering, multi-tranche, big bond offering coming to market. Tom, your thoughts on this as it crosses the terminal, kicking off a U.S. bond offering in 8 parts?
My thoughts are Team Surveillance once again nails it with the right guest at the right time. Matt Brill, David Kostin at Goldman Sachs making really clear these people are investment juggernauts. What are they going to do with the new money that they're going to pay nearly zero yield on?
Well, we're hopeful to be a little more than zero yield, but yeah, that deal will be a blowout no matter what. And whether it has 50 basis points or 75, depending on where it is on the curve, you're going to see demand coming in for it. Now, what they're going to use it for, we're going to talk to a credit analyst, but essentially what they're going to do, they're going to use it for is to drive prices lower. They're going to be using it to have less wages, have less employees, really invest in the infrastructure. But at the end of the day, Jeff Bezos told you in the past, there's two types of companies. There are those that want to raise prices and those that want to lower it. And we want to lower it. So what Amazon will be doing with this money is doing everything they can to be deflationary. And that's what the environment that we have to push and pull right now. You've got the deflationary side of things with Amazon and the Zooms of the world, and then you've got the inflationary side of things where you can't hire enough people.
I mean, John, I don't want to start any rumors here, but possibly they're bringing in the money to establish a dividend, to do a huge stock split, to become a Dow component.
Yeah,
I didn't want to go there,
I think
but
that's a little bit speculative, Tom. Let's just say that. Matt Brill, a question that Lisa would ask, I think, is these companies coming to market, the banks, the Amazons of this world, do they need the money? Why do they come to market?
Well, they don't really need the money. I mean, they have huge cash balances in most of these situations. But the reality is they can borrow for cheap. The capital structure makes sense for them. And the way they look at it is they can grow into this leverage. And if you're able to borrow for reasonably cheap, and then you're able to get the operating leverage to go with it, it results in a lot of earnings. And then you end up with a lower, debt to GDP ratio as a company. So from that standpoint, or debt to cash flow as a company. So from that standpoint, what we're looking at is just, it's very positive for them, and they can do it for pretty cheap.
But Matt Brill, this is important, folks. This is off of Robert Schiffman's wonderful work at Bloomberg Intelligence. The arch goal of Apple or Amazon, up to their eyeballs in cash, $100 billion in debt already at Amazon, tons of free cash flow, is to take their debt mix and extend the timeline, so-called extend the duration, and actually on a micro basis lower the yield while they do that. Is that the exercise?
Yeah, that's right. And Schiffman does a great job. We always talk with him, and he's been spot on this tech space where the big guys, we keep talking about whether Facebook's going to come out and borrow. Guys can borrow for so cheap, and they have such an advantage versus anybody lower than them, where they can borrow massive amounts of money, invest in infrastructure, and it keeps them ahead of the game. And that's what they're doing. They're investing rather than resting on their laurels, which is great to see for everybody, really.
Yeah, let's be clear about that. Schiffman, Leamington over at Bloomberg Intelligence, both those guys, the whole team, they help me too, Matt. All the good questions I ask come from them. Me. Let's be clear about that. 2.25 billion of their debt over at Amazon matures at the end of next year. There is a 40-year piece coming to market, Matt. Now, we talked about why a company would issue this debt. Can you help us understand why someone like you might want to buy it? Keeping you out of trouble with compliance this morning, not saying you are going to buy it. Just want to understand from your perspective, big tech firm, 40-year duration, 40-year maturity rather. Why would you want to buy that piece?
So the mindset is always, what is the insurance company doing? What are those incremental dollars looking for? And insurance companies have long-term liabilities. They need to hedge those long-term liabilities with cash flow, and that's what Amazon can get you. I don't know if Amazon's going to be around in 30 years or 40 years. I think given its market cap, it likely will. But it's really hard to predict outside of 5 years, and you get a much steeper curve. So if you look at where the credit spread of the 40-year is versus the 30-year and versus the 10-year, you're getting a lot more yield. And right now, incremental yield is the name of the game. The dominoes.
I just saw, John, the 40-year piece is 1.15 percentage points over the equivalent treasury. That's called 115 basis points. You move the decimal point over. Matt Brill, if you discount that back for any kind of inflation, basically Amazon's getting money for nothing, right?
Yeah, the real rate of return for them is probably very low. So yeah, they're borrowing. And again, I don't even think Amazon looks at it in terms of versus inflation. They look at it how fast they can grow. And Amazon's going to grow a lot greater than 3%.
Matt, well said. Matt Brill of Invesco, good to catch up.
Straits.
So we will have a 2-year piece, a 3-year piece, a 5, 7, 10, 20, 30, 40-year piece from Amazon. They are kicking off that debt sale. You mentioned the price, the initial price target may be the 40-year piece, Tom. The 2-year, 30 basis points plus.
I'm going to tear up here. I mean, how our team surveillance books a guy like Brill when this news breaks. It's an act of God.
Wasn't that perfect?
Okay, look, they're double A minus rating. IBM just went to A minus, coming off AAA. You wonder why Amazon and these others aren't going to get to a AAA rating.
Well, Tom, my question, and Matt kind of touched on it. When you have a tech firm issuing very, 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 very long-term debt, 40 years, 40 years to come, what does tech look like? What does the world look like in 40 years?
Somebody's going to be there to buy it. Which sovereign wealth fund's going to load the boat?
Oh, totally agree.
Yeah.
We'll see the numbers, that's for sure.
We did okay there. That was fun.
We did all right. And Brita Sen of Energy Aspects joining us shortly on the oil market.
Yeah.
On the pipeline shutdown and all of the above, 65.60 on WTI. Equities, all-time highs, 42.31.
Go to cash.
This is Bloomberg.
With the First Word News, I'm Rishka Gupta. There's still no timeline for restarting a giant fuel pipeline in the U.S. that was knocked out by a cyber attack. The Colonial Pipeline facility is a critical source of supply for the New York region. Fuel suppliers are growing increasingly nervous about the possibility of gasoline and diesel shortages in the eastern U.S. No word on who's responsible. U.S. Infectious Diseases Chief Anthony Fauci says there's no doubt the country has undercounted the number of coronavirus deaths, but Fauci told NBC News that a University of Washington analysis saying the true toll is probably over 900,000 is a bit more than he would have thought. The official number of COVID deaths in the U.S. is 581,000. And Prime Minister Boris Johnson confirmed that the next stage of lockdown easing in England will go ahead on May 17th as planned. People will be allowed to stay overnight with friends or relations, and indoor hospitality will be reopened. Last week, the government said limited international travel will also resume then. Iran wants U.S. sanctions to be removed from its banking system as part of talks to revive the nuclear deal. Officials from Iran's central bank are directly involved in the talks. Iranian businesses want guarantees they can work with global lenders. And credit card companies are bringing back those huge point offers. American Express is out with one of the biggest, 125,000 point bonus for some new applicants for its Platinum card. Banks pulled back after the pandemic because they were afraid they would have to eat a bunch of credit card losses. Now they want to be ready when people start traveling again. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Countries
that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
If you recall, commodities were stuck in this consolidation period from mid-March through about mid-April. All that created a stagnant level of oil and commodity demand. Now, because we have that seasonal coming back up again, that level is going to start shifting up. We're likely to see the largest level shift on record for oil demand between now and July.
And that was the wonderful Jeff Curry at Goldman Sachs, the head of commodities research, joining the Bloomberg Surveillance early team a little bit earlier this morning. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Your price action looks like this. All-time highs on the S&P, 42.31. In the FX market, euro dollar a snooze, 121.67. Cable through 141. Sterling outperformance, the Aussie stronger, reflecting a really robust move in the commodity market over the last several months. This morning, no difference. Iron ore futures in Singapore surging more than 10% at one point. Crude right now, 65.51, up 0.9%, Tom, on WTI.
Yeah, what's really interesting here, John, is it's not a normal Monday after the jobs report. I mean, we knew that wouldn't be because of the economics, a debate over the labor economy. But, John, just to see our renminbi come in so strong Chinese yuan, just as one example, you make note of that.
And this offering coming out of Amazon, kicking off a new debt deal.
Huge deal.
8 tranche, 2s, 3s, 5s, 7s, 10s, 20s, 30, 40 apiece coming to market. They kick that off right now.
Don't have size on that. They'll negotiate. We'll have much more on that. Robert Schiffman going back and forth with us from Bloomberg Intelligence. We thank him for that. Right now in oil, with a global view on what we've witnessed with cyber attacks in the United States, Amrita Sen joins us, Energy Aspects Director of Research and Chief Oil Analyst. Amrita, as you look at the distribution of hydrocarbons worldwide, how vulnerable are they to a cyber attack?
I mean, great question. I would say pretty much everywhere, more and more, I think everybody is. I mean, the Colonial Pipeline is a great example, but look at the Middle East. A lot of even upcake to that matter. There were elements of kind of cyber attacks involved in that. But even more recently, within the Middle East, you do get a lot of infrastructure, not necessarily disruptions, but targets. And I think this is just the new normal. There are more and more companies spending on this, and it just needs to get higher from here because, you know, the warfare generally is changing. The landscape's completely changed.
I mean, in Malaysia, they're doing a 24-mile, 30-mile key pipeline having to do with the distribution. I believe it's up the west coast of Malaysia. How many spots do you perceive to be out there like the Colonial Pipeline worldwide? Is it 10 other hotspots or is it hundreds?
It's going to be hundreds because if you think about the distribution, I mean, if you're really going down that route, you're talking about a huge distribution or pipeline networks within China, within India, even Europe. Europe has a huge network, both for crude and for products. Looking more broadly then, Amrita, when we talk to anyone in the commodity market right now, they're not concerned about this Colonial Pipeline shutdown. There's just a belief that we'll adjust, it'll come back online and we'll get back to normal. Any aspects of the infrastructure, the distribution in America, the transportation of energy that you would be concerned about? Generally, everything should be back up and running in about 3 to 5 days, but you know, never say never. It's definitely unprecedented in the scale at which it's happening. So it will require coordination from various government bodies, and that can take some time. I don't think there's going to be more. And I think after this attack, I do think a lot of U.S. networks, natural gas as well, let's not forget that, they will probably tighten up what they can do to protect their networks going forward. Amrita, going forward from here, build on the other issues surrounding the oil market right now. We've talked a ton about supply.
Let's talk about it a little bit more. Out of Iran, can we open things up a little bit more? What do negotiations look like? If you said 12, 18 months ago that we'd have a President Joe Biden, a Democratic sweep, we'd be talking potentially about loosening things up with Iran. Are we still having that discussion?
Yeah, we are. And, we've always said that we're expecting some kind of a breakthrough over kind of April and May and then sanctions relief by July. I will say, however, talks are progressing, but progressing probably a bit slower than we've been expecting. No major changes, but the thing I will warn is that everybody is expecting a deal in the coming weeks and then sanctions relief over Q3. But if there isn't a deal before the Iranian elections, which are next month, that's the thing to watch out for, because then it could get dragged on and then the deal becomes a 2022 story. I don't think that's in the price at all.
What is the link, Amrita, that you see between oil as a huge weighting of CRB or the Bloomberg Commodity Index with all the other commodities? They don't trade in lockstep, do they?
No, not at all. And I mean, if you guys were saying as well, just S&P at record highs, but if you look at metals markets are soaring, and oil has been a very strong performer this year, but still hasn't been as strong as some of the other commodities. And part of that is because, transportation was the worst hit during COVID. It is coming back, but it's not fully back yet. But there's also so much kind of talks around working from home. How much are we going to lose permanently for oil demand? But I mean, I will say this, all the data we're getting right now, personal incomes are back at pre-COVID levels in many, many parts of the world. I think this summer is going to be huge. People are going to spend, and the bounce back in oil demand is probably going to be significantly more than people have been expecting.
That is the line that Jeff Curry at Goldman's pushing too. Amrita, it sounds like you're on the same page. It's good to hear from you. Amrita Sen there of Energy Aspects. Looking forward from here. Here's the take from Morgan Stanley. Just drop it into the inbox. Bottom line, dreaming about a reopening is likely much easier than doing it. Given that stocks are discounting mechanisms, they go on to say, it's often better to travel than arrive from an investment perspective. As a result, we think it's time to be more selective and, Tom, a tad more defensive.
Well, there's just, I would say on this Monday after jobs, John, there's 14 opinions out there. I mean, the Bulls reaffirm, the Bears reaffirm, and as we heard from a guest an hour ago, it's going to be a lot of fun this summer.
I agree.
It's going to be sport.
I agree. The line into earnings season from Morgan Stanley, though, was execution risk. Going into the data, execution risk. I think we saw that in earnings in a lot of places. Well, Caterpillar, Ford being examples of that. And I think we saw it in the data on Friday too.
And I said, and John, you and I went back and forth on this, off of Friday data, how do you recalibrate your GDP guess? The Morgan Stanley call is boom GDP, and then it gets slow somewhat quickly.
Deceleration.
Amrita just pushed against that. She said, no, she sees global solidity.
You'll see the demand. I don't think demand is in question. We will see the demand. It's executing the supply side of the story that gets a little trickier.
Fair.
There's a seasonal factor in the Friday print as well that it's incredibly confusing, the whole data point was. We can move on from that. But I think it is an example more broadly, Tom. I think most people assume it's an example that we've got some execution risk here. And we talked about this on Friday. 1 million jobs, that's real people. 1.5 million, 2 million, the 10 million, the hole we need to fill. It's real people. It's a real hiring process. It's not as simple as just saying, we've got great demand, let's click our fingers and everyone turns up.
Yeah, I went to Economic Policy Institute, Heidi Sherholz and the wonderful people there, and I'm sorry, it's 8 million jobs. And if you extrapolate out what growth would have been February pre-pandemic, maybe it's as many as 10 million jobs. And as you say, those are real people.
Equities right now, all-time highs. We approach 42.29. We're through that right now, up about 0.2%, approaching 42.30 on the S&P 500. Tom Keene, Jonathan Ferro, Lisa back Monday. This is Bloomberg.
focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
On Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live on TV and radio, this is Bloomberg Surveillance, just reflecting on that line out of Morgan Stanley. Dreaming of reopening is likely much easier than doing it. Have a think about it. Futures right now, 42.29 on the S&P. We advanced by almost 5 points, up a little more than 0.1%. Tom, the turnaround in this market is just unreal. Think of the numbers we're talking about right now. Let's not try not to be desensitized by this. We're having a discussion about 11K on copper. We're looking at 42.30 on the S&P 500. Back in November, we were looking at the low threes, the mid threes. Yeah. And anything north of 4,000 was uber bullish. Here we are in May, 42.30 on the S&P 500.
Do we celebrate Dow 35,000 this week as well? And John, what it means to me is the bulls have to recalibrate. They can take a victory lap, they've been wrong, but you don't just extrapolate forward in this milieu. You've got to really think about where you go, say, to year-end 2021.
I've got my Dow cap on just for you, Tom, ready to go. I'll bring it to work in the next couple of days.
35, it's a round number. Where's the VIX go? Does the VIX break down to 15?
Don't know, but Mike Wilson and Morgan Stanley's point at the moment, Tom, some evidence of that inability to execute, not just in the earnings, but also in the payrolls print maybe on Friday. Switch up the board and get to the bond market, 2s, 10s, 30s. You saw how we pushed that jobs market data through this bond market. Gap lower, 146, a huge break lower on a 10-year yield. Then we unwound it really quickly. Right now, 157.19. Just a consensus view, we do not have a demand problem. It's not my particular view, it's a consensus view that we are working our way through a demand shock. That was the overwhelming response to the data on Friday. What we couldn't work out was what was holding back supply. Let's talk about filling that gap. Final chart here. It is the jobs data, the jobs openings. We'll get some more data on this tomorrow.
The JOLT survey.
The JOLT survey, Tom, and job openings in America are surging. Yeah. The unknown is how we fill the gap.
No, breaking out on radio here to help out, and Michael McKee loves his survey, John. It's very good math, breaking out to new highs off of where we were a few years ago. There's lots and lots of openings out there.
Yep, and the issue on Friday, as we saw, Tom, great, lots of openings, lots of demand. Yeah. Are the people going to show up?
They will. Right now, and this is a joy, folks, to talk conservative theory in America with Diana Furchtgott-Roth at George Washington and moments ago at the Trump administration, Department of Transportation, but far more than that, truly one of our most consistent voices on conservative thought and indeed economic doubt across America back to the presidency of Ronald Reagan. Professor, thrilled to have you with us this morning. What does conservative thought do after Trump? How does a conservative thought recalibrate after the president's 4 years?
I don't think it's necessarily conservative thought, but I think if anyone were told that you could earn $15 an hour for staying home, you'd be more likely to stay home than go out to work. That's why 3 states, Arkansas, Montana, and South Carolina, have announced that they are cutting back on expanded benefits for unemployment insurance because people are staying home rather than going out to work. And I think it's really noteworthy that when construction was booming, there was 0 jobs created in construction last month.
President Biden takes the middle ground here between fractious Democrats and Republicans recalibrating for 2022. Can President Biden find a middle ground to bring the two parties together, or do you just assume warfare out to 2024?
Well, so far, President Biden has listened more to his left-wing flank, the Bernie Sanders wing, and I don't know what he's going to do in the future, but so far, he has not wanted to negotiate or compromise with Republicans. We'll see what he has to do in the future. I don't have any information.
No, that's fine. But Professor Fritz-Roth, I want to make clear, you have been a consistent theorist for conservatives for 20, 30 years. We've got Nick Burns, who may handle some State Department duties for President Biden. There is a Republican set of individuals trying to reset after Trump, and they're really struggling. Witness Cheney of Wyoming as well. How does the more traditional Republican Party reset after the era of Trump?
Well, I'm an economist. I'm not a political scientist, but all I can say is just point to the empirical evidence. For example, in North Carolina in 2013, when it cut unemployment benefits, it created far more jobs than the surrounding states. So we need to look at the supply side phenomena that are keeping down the jobs growth.
Well, let's talk about that a little bit more, Diana. What do you think was behind the drop in female participation in Friday's report?
I think it's really obvious that when children have to be home from school, someone in the family has to be with them. And this past year, it's fallen very much on the moms. I don't know how they do it. I could never have managed to work with my 6 children at home. It's really difficult to work with your children home.
With that in mind, is it a mistake to pull back on unemployment insurance then?
We need to open the schools so that children can go back to school, go back to summer camp, take off some of these mask mandates for people who are vaccinated, and get the kids back to school, show the moms that yes, they can be going back to work with the confidence that their children are going to be able to be in school and in summer camp.
Is that where the emphasis should be then, Diana? Not pulling back UI insurance, unemployment insurance, and the additional benefits from the federal government. Before we get there, we need to reopen the schools and do something about childcare. Isn't that where the emphasis should be this Monday morning?
It doesn't really help giving women more unemployment insurance benefits if their kids are at home and then they can't get back to their job.
Okay, well, this is critical. Come on, you admit to 6 children. I wasn't as dumb as you, but I came awfully close. Diana, you've got to admit, you said to one of your children before, hey, you, right? I've never been guilty of that, John. Hey, you, be good. Okay, so for the multiple children story, Diana, and this is not funny, what is our solution of a national embarrassment on child care? Do you advocate what we see in the Netherlands? Do you advocate what we see in France?
Look, it's not like we've done that great job of kindergarten through 12th grade that we want to extend it up through community college and down through pre-kindergarten. But this is up to each individual state to decide. It's up to each individual state to decide what to do. Women's labor force participation was very high in 2019 when there wasn't federally paid childcare.
Okay.
There was not community colleges. Unemployment rates were the lowest for minorities and for women.
Are you suggesting, Diana, this is critical? Are you're falling back on a states' rights issue. I understand that. But are you telling me that George Bush Sr. or Ronald Reagan wouldn't say that there's a federal solution to the horrific behind that is American child care?
First of all, I wouldn't say that American child care is horrific. There are many, many child care providers, and we could see in January and February 2020 that women were doing great. And we need to go back to that time. 3.5% unemployment rate. It worked for everybody. A growing economy.
We need to get that back very quickly, Diana. We've got to leave it there. Diana Fritz-Roth there of George Washington University. On some of the debate right now, Tom, it starts with the economics, but it often ends up in a political one, and it's a political conversation at the moment in Washington.
Yeah, we don't have to spend a lot of time on this, but all it comes down to, John, is a fallback of states' rights versus federal solution. The Democrats are looking at a federal solution. The Republicans, and particularly very entrenched conservative Republicans, as witnessed by the professor, are looking at a states' rights solution. And all I know is every anecdotal evidence I have is women can't go back because they don't have child care.
Child care issues, and we saw that in the data on Friday. We saw that in the participation rate on Friday. Tom, the dilemma's as follows. It hasn't changed in the last several days. It's the same thing. Demand's not a problem. Why didn't people show up to take the jobs? Job openings aren't a problem. Why aren't people there taking them?
And we're going to, Charles Evans just out with headlines from Chicago. You know, we're going to get back, John. We're going to get there. Maybe it's going to be slower, herky-jerky, whatever it is. But I'm going to go back, John, to the reality of inflation. I got too many suits and ties, including Elon Musk, I guess, indirectly on SNL, telling us inflation doesn't matter. All the fancy people are telling me inflation doesn't matter. It will become a massive political issue based on what I see on the Bloomberg screen.
Well, I think it becomes a lot more interesting as well on the Labour side, Tom, if we get away from maybe one-time sign-on bonuses and actually start talking about higher wages. The solution to the labour shortage last month, was it higher prices? I don't know about that, because if you think it's about childcare, then I don't think higher prices solves that, does it? Unless they're sufficient enough to sort out childcare.
We'll have to see on wage inflation. I mean, John, which inflation statistic matters on Wednesday? To me, it's the Atlanta sticky inflation number, which is creeping up. It's
I've made the point. It depends on who you are and what your perspective is. I think for the Federal Reserve right now, they're looking at the PCE. And for the Federal Reserve, they're still standing by this philosophy that this is just a one-off price gain brought about by the reopening and restart of this economy. And over the course of the year, the supply side will work things out. They're not going to reassess that point until the end of the year, the start of 2022.
And John, I'm going to go back to Connor Lamb, the banner, folks. We had, for those of you on radio, I showed how close Connor Lamb's election was. What we're dealing with here, John, in economics, finance, and investment goes right into the politics. And I would suggest that over the weekend, we really became more acute to that Wednesday meeting about the politics for 18 months.
Yeah, and everybody you speak down in Washington, D.C., everybody you speak to down there, Tom, says the same thing, that the pressure is more on the president than on the Republicans right now to cut this deal.
Well, John, you've once again, the guy from England has said it, and it's well said. It's just amazing.
It's well said.
It's well said,
It's your favourite phrase at the moment, isn't it?
It is my favourite
it's well
phrase.
Said.
It's well said,
Well
John.
said.
Well said.
You want to talk about that Amazon offering?
No, I want to talk about the Dow up 120 future points first. Do Amazon.
Let's talk about that Amazon offering then.
Thank you.
8-part offering, 40-year security may yield around 115 basis points over Treasuries. You mentioned that earlier on this morning. Some of the reporting from Molly Smith and the team here at Bloomberg News. Tom, Amazon coming to market. These yields are going to be so low.
They did it with Whole Foods, and then they did another tranche after that, and now a new one, what, 10, 20 billion? I don't know, but, you know, what are they going to do? Are they going to buy Chewy? I mean, I don't want to start a rumor.
You want them to buy Chewy? You want them to do a stock split? You want to place on the board too?
I don't know. Yeah, I do. Well, they called, and I said, no, I can't do it.
Oh, because you're busy doing this with me.
John Micklethwaite said that I couldn't do it.
Is that what he said? Yeah. Coming up on the Open, BlackRock Global Head of Research, Jean Bavin. And I can tell you the team at BlackRock, especially led by Jean, believes that pickup in inflation, Tom, might be a little bit more persistent.
Yes, tangible.
Years to come.
Jean Bovin, formerly with the Bank of Canada, I should say. He's very good.
From New York City this morning, good morning. Tom Keene, Jonathan Ferro, Lisa Abramowitz taking a week off. A well-earned week off.
I thought she's coming back Monday. That's today.
Next Monday. Next Monday. One more week, Tom. All-time highs in the equity market.
When was the last time I had a week off?
On TV, a couple of weeks ago.
Thank you.
This is Bloomberg.
And it was transitory.
With the First Word News, I'm Rishka Gupta. Crude oil and gasoline rose after a cyber attack put the largest oil products pipeline in the U.S. out of action. Colonial Pipeline still hasn't come up with a timeline for restarting operations. Fuel suppliers are concerned there could be a shortage of gasoline and diesel across the eastern U.S. President Biden is preparing for his first face-to-face meeting with Republican leaders Mitch McConnell and Kevin McCarthy. Wednesday's meeting comes as Republicans are ramping up their opposition to the president's $4 trillion economic plan. There's not much expectation for a breakthrough at the meeting. Last week, McConnell said he is 100% focused on blocking Biden's agenda. And in Jerusalem, weeks of violence threaten to escalate on the day Israel celebrates its control over the contested city. Palestinians clashed with Israeli police and at least 50 Palestinians were hospitalized. Israel is marking the anniversary of the day in 1967 it captured Jerusalem's eastern sector from Jordan. And Amazon is selling bonds in its first debt offering in almost a year. Bloomberg's learned the online retail giant is issuing debt in 8 parts. The longest portion is a 40-year security. Amazon will use the proceeds to refinance debt and buy back stock. No word on how much the company plans to raise. Last June, Amazon borrowed $10 billion for general corporate purposes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Riska Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Day, a Bloomberg exclusive conversation. Dallas Fed President Robert Kaplan joins Balance of Power live at noon Eastern on Bloomberg Television and Radio.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Leisure economy, which includes restaurants and travel, is up significantly as far as job gain, and more people looked for jobs in the month of April than the previous month. So we're seeing positive signs as we continue to move forward here.
Secretary Walsh, there on Jobs Day, our most interesting Jobs Day, a stunning surprise in my history of doing this. No greater than surprise what we see on Friday, and it moves forward to today. Amazon out with an 8-tranche, many billions of dollar deal. We don't know that dollar amount yet. And of course, in the markets, I'd say the number one thing for me is the real yield pullback here to ever more negative numbers. 10-year real yield negative 0.96. This is the right person at the right time to talk about the retail cadence of America. Friday, we get retail from the lowest price point to the highest price point, and Steve Sadoff is expert at this. Mr. Sadoff is with MasterCard, senior advisor, but that barely describes his contribution to retail. Herbal essence and all that boom a million years ago in shampoo, it's Sadoff's fault. And he's the guy at Saks who brought us exclusives, literally inventing that out of pixie dust. Steve Sadoff, let me talk about MasterCard and the knowledge that MasterCard has tick by tick. And you say it even goes over to department stores are enjoying this resurgence.
Good to see you, Tom. And yeah, I think that the month of April, the MasterCard Spending Pulse numbers show that the consumer is really coming back with a vengeance. You saw overall sales, and this is now not just the MasterCard sales, but it cuts across all forms of tender. Sales were up 23.3% versus year ago, but importantly, they were up 10.8% versus 19. And this is ex auto and gas. So you're seeing a consumer that's coming back, and it's across all sectors. You mentioned department stores, but it's in restaurants, it's in the categories like jewelry and apparel, and you're starting to see the consumer saying, hey, I want to get back out again.
Let me ask you a sell-side question then. Are we pulling forward next autumn sales? Are we redoing the closet now where nothing ebbs as we go into the holiday season? What is that dynamic?
Well, there's no question that we're redoing our closets. We've been wearing sweatpants for the last year, and you're seeing a new fashion cycle starting. The guys in the jean business are all talking about baggier, higher waists. It's a new newness, excitement, getting out again, and you're seeing it hit just the apparel fashion, but you're seeing it in the handbags, the shoes, the jewelry. So I don't know that it's necessarily pulling forward the volume from the fall because there's so much pent-up demand and savings that's out there. And the interesting thing is it's not just online anymore. Online is now 21% of all commerce and growing still at 20%, but people are back in the stores, and brick and mortar is starting to see that pent-up demand.
Steve, I'm going to avoid the baggy higher waist thing. Somehow I don't think the higher waist jeans is going to work on me as well. Steve, you are a student of all this, and if I can move up the scale to luxury and such, will there be a consolidation? We have luxury, which is 3 big French companies. You know it better than me. But how do we come out of this on an equity basis? Further consolidation, or is it going to be entrepreneurial with IPOs and the rest?
I think it's going to be a combination of both. You have the strong ones are going to be picking off some of the big brands. You'll see the consolidation for the LVMHs and the Richemonts of the world. But you're seeing companies like the Tapestries performing much better. I think you're going to continue to see these niche segmented brands that come out and do their IPOs. The consumer wants values. They want a story. They want to, and I think that in the luxury space, you're going to continue to see a lot of innovation.
Steve Sadoff, to bring it back to MasterCard and your work for them now as a senior advisor, how is our relationship with our cards changing? There's a lot of dynamics in fintech and digital dynamics. How does MasterCard model that forward?
Well, I think what you have is a consumer that is going much more cashless, so that they want touchless, they want ease of transaction, they still love their cards, and I think that it bodes very well for the MasterCards of the world in terms of the changing behaviors. And it's not just the transaction, it's what you do with some of the data and the analytics and the ability to understand consumers better. I think that this is the value-added proposition that all of these the retailers need, and you're seeing a lot more of that coming out of the use of data in meeting the consumer needs on a level of one.
What is the permanent change of the consumer out of this natural disaster we've all lived?
I think the consumer go back to the value and values They want to be safe. They want to be able to get what they want when they want it. This omni-channel shopping is here to stay. These are some fundamental changes that had started earlier before the pandemic that have probably accelerated 6 years over the last year in terms of the shift to omni-channel and segmented and differentiated brands.
You just described Amazon. They're doing an 8-tranche offering today of $1 gazillion in bonds. How does Amazon adapt to the Steve Sadoff world?
Oh, Amazon's a winner. I think the Amazons, the Walmarts, the Targets continue to do well. Doesn't mean they're the only ones that are going to do well, but marketplaces are important in this environment. They're not going to, Amazon's not the only marketplace. You're going to have the Farfetches of the world that will do well. But the consumer loves convenience, ease. Amazon sets the standards. The way that they do the presentation of the product, they understand the personalization. That's going to be the expectation. Amazon's a winner over time, but I think that there's going to be a lot of others as well. And you also have these new evolving, whether it's the resale, the rental, all of this is this new age in terms of how retail's evolving.
Steve Sadoff, does Amazon take luxury from luxury? I mean, is Gucci going to actually sell off Amazon?
My guess is the answer is probably not. I think that the Gucci's and the LVMHs are going to play in other kinds of marketplaces. Maybe they'll play in the Farfetches, the Net-a-Porters, the Saks.com, which is separated from the full-line stores. I don't know that those brands play in the Amazon world, but Amazon will play they'll be the major player in apparel. I'm just not so sure it's going to be at the very high-end luxury.
It's been too long. Steve Sadoff, thank you so much. Greatly appreciated. Inventing retail and exclusives at Saks and, of course, at MasterCard as a senior advisor. So much to talk about today. It's been the most non-boring Monday after a jobs report I've ever seen. It's personified by DXY, about ready for an 89 print. That's a blended bundle of major trading nation currencies. That's a huge move, 92 down to 90.06. You see that expressed through sterling at a 142 rounded up. Renminbi 6.41 yuan, stronger sterling, stronger renminbi, and everything in between as well. The yield space is fascinating. There's no other way to talk about it. With yields down, the 2-year yield right now, my eyes are failing me here. 2-year yield, there it is, 0.1449 in the 2-year yield, and higher yields out in the 1030 space. That'll be one of the themes of David Weston in speaking with Robert Kaplan of the Dallas Fed. The last time President Kaplan spoke, he moved the markets. We'll see if he can do that again. Stay with us on radio and television. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
All-time highs coming into Monday from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. 42.29 on the S&P 500. We advance another 1/10%. We begin with the big issue, a supply-side mystery.
Everything has to be put on the table at this point.
There's a lot to disentangle.
Whether it's unemployment benefits, whether it's, going back to school.
Until we get the schools open again. You have a lot of parents at home.
Unemployment insurance payments that are keeping people at home.
A little bit of a skill or interest mismatch.
It could be a skill mismatch.
All of these things are factors.
That's why it's more a supply issue in my mind.
So let's just cut to the chase. People are going to have to start paying more for labor.
We'll start to see higher wages.
It could bring wages up.
But it could be short term.
You have to take all the data this year with a grain of salt.
The data right now is extremely noisy.
So much volatility in the data, so much uncertainty.
The reality is we don't know.
There's nothing conclusive here.
We have to get a lot more data.
We need more data. Let's bring in BlackRock's Jean Barvan, Ken Torbs of Amundi with us as well. Jean, let's just begin with you, sir. The overwhelming consensus view, and forgive me, I'm struggling to move on from Payrolls Friday, it's Payrolls Monday. The overwhelming consensus view is that we don't have a demand issue, and that was not reflected in the payrolls report. It's a supply-side story. Do you agree with that?
Well, I think you heard some comments in the intro. I think there's a lot of pause that needs to be made here. It's one number. We don't have a good handle on restart dynamics. And when you look at under the hood, there's a big seasonal story here. Seasonal adjustment where played a big role. If you don't make the adjustment, we had 1 million job created in the month. So we don't know what's the seasonal pattern at this stage in a restart economics. So I'm taking a bit of all of that with a grain of salt at this stage before drawing big conclusions.
Ken, what's your take?
I think the labor market's strong. I think it is a supply problem. I think the weight of the evidence is in some of the details of the report. Average monthly earnings were up 0.7. Okay, that's pretty high, particularly in light of the fact that most of the jobs created were in restaurants and hospitality, which are not the highest paying jobs in the United States. Furthermore, the work week extended, so people are being asked to work more overtime. So I think the weight of the data suggests companies are struggling to hire employees.
So do we have an execution problem? Mike Wilson over at Morgan Stanley weighing in over the weekend. He publishes this morning, and on Sunday, of course, said the following: dreaming about a reopening is much easier than doing it. Goes on to say, given the stocks are discounting mechanisms, it's often better to travel than arrive from an investment perspective. As a result, we think it's time to be more selective and a tad more defensive. Ken, just weigh in. Your reaction to that. Do you think it is a time to be more defensive? Do we face some real execution risk here in the months to come?
Well, the market has, in fact, discounted a pretty robust reopening V-shaped recovery, and a lot of that is priced in. But there are areas of the market that look interesting. I think energy and materials look very interesting here. People are underinvested in it because of various reasons. Furthermore, consumer staples are beginning to look more interesting, particularly in light of the fact that they've historically been able to pass through price increases. You know, you're going to buy a tube of toothpaste no matter what the price is. They can go up 10, 15%. It doesn't add a lot to your expense. So I like staples here, I like energy, I like materials. Furthermore, I also like overseas markets. Keep in mind the U.S. Has outperformed this year on the heels of a much stronger reopening. And I would say that Europe is finally getting its act together somewhat on the vaccinations. And I think that the commodity boom and the rest of the world will come along in the next few months. And I think the dollar is also in a little bit of trouble, and I think that could be a little bit of a tailwind. So overseas markets look also a little bit interesting. So rotation might be a good option here.
3 points there. Let's pick up on all three of them. A little bit later in the program, we'll do the overseas phenomena. So sit tight on that one. On staples, Julian Emanuel of BTIG is with you. Pricing power, the issue there. The other point that I want to touch on as well, and John, I want your view on this, just the energy story. WTI 65, commodities, iron ore, surging, Singapore futures ripping more than 10% overnight. Copper again, we're on 11K watch at the moment, and yet there are some people that sit here, John, and say there's reason for pause. Let's reflect, get a bit more defensive, raise some cash. What's your take?
I think the restart is still very much, powerful dynamic that hasn't completely played out yet. As the colleague was mentioning here, hospitality and leisure were up 230,000 jobs in the month. So this is happening. That was the most depressed sector, and so we are seeing that happening. I think that has more to go. So in that context, we are recommending to remain pro-risk in this environment. The restart is continuing. At the same time, we think we should not extrapolate too much staying power for the growth numbers that will be high watering over the next few weeks and months. And as a result, pro-risk, but at the same time, we haven't reset to the beginning of a long recovery. So that I think it's a near-term boost, and we shouldn't read too much into that.
42.28 on the S&P 500, all-time highs. Guys, sit tight. Big week ahead. Mike McKee has the numbers for you. Morning, Mike.
Good morning, John. Well, as your guests have been saying, there isn't consensus on what went wrong on Friday, why we got so many jobs that didn't appear. But this week, we'll get some of the underlying data that may give us some clues, starting with tomorrow when we get the JOLTS report and the small business report. Small businesses, we'll see how reopening is going. They've complained already about not being able to find enough workers. And the JOLTS report, while it's 2 months delayed, is expected to show there are 7,500,000 jobs open in the month of March. There's a mismatch going on somewhere. Wednesday's a big day with CPI. Talk about that in a moment. And Friday, the other big number, retail sales on Friday will tell us something about the consumer and about demand. Does demand remain strong? You're talking about a supply-demand problem. In terms of the CPI, this is going to get everybody's attention on Wall Street because of the base effects and because of supply chain shortages. We're going to see the highest CPI inflation since 2011, according to the forecast, 3.6% on a year-over-year basis. That's way ahead of where the Fed is looking for inflation to be. They say it's going to be transitory. Join John for the discussion on Wednesday. There'll be a lot of talk about that. And what is the Fed going to think about it? All week long, you'll hear. There are 12 Fed officials out of the 19 speaking this week, including 4 tomorrow. We get the vice chairman, Rich Clarida, speaking on Wednesday. There's going to be a lot of news out there from the Fed. Most of them probably saying, we don't have enough data yet, John. Maybe they can't say that by Friday.
That debate will continue. Mike McKee, thank you. Of course, we caught up with Minneapolis Fed President Neil Kashkari a little bit earlier last week. Take a listen to what he had to say to Mike.
My friends on Wall Street, and I have a lot of them, I hear from them all the time complaining about the Fed's policies that are mucking up their trading strategies. I have zero sympathy because there are still 8 to 10 million Americans who want to work, who ought to be working.
Let's bring in some friends on Wall Street. Jean Bonvin, Ken Taub, still with us. John, what's interesting about that line is that I know for a fact, without even asking the two of you, is that you both agree there's more work to be done in the labour market. Where there's disagreement on Wall Street, it's whether $120 billion a month of QE helps them achieve that objective. Does it, Ken?
Well, I'm not convinced at this point. I don't think there are a lot of impediments to hiring from a financial perspective. Banks are healthy, rates are low, credit is seemingly relatively available. I don't think it's a Fed problem. The Fed, it seems to me, the only thing they can do is tighten up the labor market tighter and tighter and tighter. And it's not clear to me that the associated and generalized inflation will not outpace some of the wage gains. So will it really positively affect people? I'm not convinced yet. So I think the Fed's done about as much as they can do. And the impediments are training, skills, getting people less incentive to not work. I think there's other things to be done rather than interest rates at this point.
You're not convinced, Jean. I know you're not convinced either of this transitory debate, this transitory argument the Fed is making. Why not, Jean?
Well, I think there's pretty powerful forces that will bring inflation, higher over the next few years. I think we are seeing structural cost adjustment that are persistent in our view. We're seeing also a big change in the Fed's framework. I mean, that's something I think is, I don't think it's fully digested yet. I mean, last summer, the Fed has changed its framework. They're trying to, shoot through their target and maintain inflation above their target for a sustained amount of time. And they've also changed their unemployment goal as well to a much broader concept of unemployment and inclusive. I mean, for those two reasons, I can debate whether this is the right policy or not, but it doesn't really matter. I think they've told us that they need to, do a lot more to boost inflation. And so until they're convinced that inflation is sustained and not only transitory, I think they have to continue with, the support that they're putting in place.
So you already believe that they might be wrong and that actually it will be sustained. What's the capital allocation decision that you're making, John, off the back of that?
Yeah, the inflation story has been, like, for us, a big story. Starting last summer, we've been, long break evens and playing the inflation story pretty materially. We think that still has some more to play out. However, a couple of weeks ago, we thought that, like, the near-term inflation, even though everybody now is all excited about inflation, the near-term dynamic is much less clear. And so we're neutral in inflation from a 6-month to 12-month basis. Beyond that, if you have more of a 5-year horizon, I think you need to go for protection for inflation. I think equity in this environment is still a good place to allocate because I think it's going to be reacting more favorably to the kind of inflation, but still modest inflation we're going to see over the next few years.
Ken, that's John's view. What's yours? Final word.
Well, I think he's right. I think the Fed for the last 40 years, at least the first 30 of them, was interested in disinflation. Today, they're interested in getting inflation up. Today, they've taken on a third goal, equality as an outcome. President Kashkari, Fed President Kashkari said that we're not going to protect your capital. We're more interested in getting wage inflation higher. So inflation's going higher on top of the fact that the economy is poised for a huge rebound. Inventories, by the way, continue to decline everywhere. So we're set for more and more manufacturing. And by the way, this is before the rest of the globe is really open as the U.S. is. So I think we're into this for years to come, frankly.
I promised you we'd talk about the rest of the world. We'll do that next. Ken, Jean, sticking with us. Your equity market record highs with the movers at the market desk. Here's Abby.
John, let's start out with the big story over the weekend. That, of course, is the hack of Colonial Pipeline and the fact that we are now on day 3 of the nation's largest pipeline. If we take a look at some of the largest publicly traded pipeline companies, we are going to see, not surprisingly, some gains. Maybe not as much as you would expect, but we do have the likes of Kinder Morgan and Williams trading higher. As for E&P and natural resources company on the energy side, also gains in sympathy with oil rising. Interestingly, natural gas is down. Gasoline futures, though, are sharply higher, and you can see Phillips 66 up more than 1%. Some of the other, again, E&P names higher. Rounding it out, metals and miners. Also, we have gains, and this, of course, is with that continued rally for metals. Iron ore is hot. Copper, as you said, close to 11,000 in London trading. We just see these commodity stocks going higher and higher, John.
Pick a commodity, it is flying. Abby, thank you. Coming up, new U.S. COVID infections dropping to the lowest level since late September as EU leaders urge President Biden to lift restrictions on vaccine exports. That conversation next with BlackRock's Jean Bavin and Ken Torbs of Amundi. From New York City this morning, good morning. 17 minutes away from the opening bell in New York. Equities up by 0.06%. We sit pretty at record highs on the S&P 500. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
You've got to get trusted messengers out there, getting people to understand why it's important to get vaccinated for themselves, their family, and the community. And, you know, different types of people in different phases in life have different trusted messengers. It could be sports figures, it could be entertainment figures, it could be clergy, or it could be your family doctor. That's the first thing, trusted messengers.
Dr. Fauci there addressing concerns about vaccine hesitancy. This as EU leaders try to increase output in Europe and elsewhere, urging the US to lift vaccination export restrictions. German Chancellor Angela Merkel saying the following: I hope that now large parts of the US population have been vaccinated, that there will be a free exchange of vaccine materials and an opening of the markets for vaccines too. I want to head to Brussels and catch up with Maria Tadeo this morning. Morning, Maria.
Good morning, Jonathan. Where they're clearly now pushing back against Joe Biden and this proposal to lift the IP restrictions on vaccines. For the Europeans, it's very clear that the problem when it comes to supply is not so much the IP, but the lack of production capabilities and restrictions on exports. So the message is very clear. Countries like the US and to some extent the UK, they should be exporting a lot more. That is on the technicalities, but as always, there's politics that play into this. For the Europeans, there's almost this feeling that President Biden just blindsided the EU and now has decided to come across as a champion of free vaccines. The Europeans, they say that they don't want to take lessons in solidarity and that if anything, they should be the ones taking credit for exporting vaccines to the world. The US and the United Kingdom should be doing much more.
Let's compare the progress in each respective region right now. Maria, I mentioned this quote from the New York Times. They lean on some of the data from AP. Wisconsin officials have asked for just 8% of the doses the federal government had set aside for the state next week. Iowa, just 29% of the state's allocated doses. Illinois, with the exception of Chicago, within Illinois, 9% of its allocated doses for everywhere else within Illinois. So, Maria, my question to you right now is, that's the United States. That's the picture here. Average rate of vaccinations has dropped over to about 2 mil. Where are we in Germany, in France, in Spain, Italy? Are we still accelerating?
Yes, and look, it's a very different picture now. When we spoke about a rollout that was complicated by so many different things, that would not be accurate at this stage. This is a rollout that is now gaining momentum, that is picking up. To some extent, Germany is vaccinating 1% of its population, around 1 million people on a daily basis, and we're also seeing that replicated in Italy and Spain. There is now a deep belief here that there will be herd immunity achieved before the end of the summer, so that is moving ahead of the initial goal, which was September. Now that's moving into August. And in fact, the Europeans are quite optimistic that this year they'll be able to save the summer season, which, as you know, is hugely important for Southern European economies.
My flights are booked already. They have been for months. Maria, thank you. Let's hope we can open things up in the months to come. BlackRock's Jean Barvin with us. Ken Sorbs of Amundi. Ken, you mentioned earlier you like the rest of the world. Is Europe a part of that?
I think so. As their economy opens up and as we get a better economic output, I think given the value nature of the European economy, you should begin to see better numbers out of Europe. I think one of the pieces of evidence is the German Bund spread to the 10-year Treasury has begun to narrow. And that's a good sign that things are getting better in Europe. And with some delay, you should see companies begin to do better there.
Jean, does that argument stack up for you?
Yeah, I think we've been careful on Europe for a few quarters now on the back of the rollout of the vaccine. That was a lot more challenge, as you've just talked about. I think this is a story though of acceleration from here, because what hasn't been restarted will be restarted more quickly after, in our view. So I think there's there's the dynamic that's going to get stronger, as well as the fact that as the U.S. is getting out and accelerating, that also benefits the rest of the world. That said, I think we would favor more like emerging markets at this juncture. Local currency emerging markets seems to us pretty attractive, especially since we think that the Fed remains pretty dovish, and that's constructive for that space.
There's a weak dollar theme in that, and Ken, you touched on that as well a little bit earlier on the program. When you're thinking about how to push this view through the market, you mentioned spreads narrower between Germany and the United States. They've got a dollar index threatening to break 90 to the downside. How much dollar weakness are you looking for, Ken, in the months to come?
Well, it's unclear what the level will be, but I think the direction is certainly lower. We've got the backdrop of the twin deficits, coupled with now a Fed that is going to keep rates low. In fact, we'll have more and more negative real yields. This will become unattractive, and as the spreads between the rest of the world and the U.S. narrow, that advantage for the U.S. dollar, which has been in place now for the last 3 months, I think is one of the reasons why the dollar hasn't really depreciated much over the last 3 months, because our rates had risen so fast. But as that begins, that gap narrows, as the twin deficits continue to be a problem, and furthermore, as the rest of the world does better, people will be attracted overseas. And so I think that's the one price the Fed is not going to easily be able to control. And that's a key price to watch, because if markets become less confident in the Fed's notion of transitory inflation, I think it'll show up in a weak dollar first.
What's the optimal way of playing that, Ken? Through the FX market, a derivative of it, the commodity market, energy, EM? What would you like to do?
Well, I like the emerging market story as well. I think the commodity story is more sustained than people may believe. Of course, commodities have significant ups and downs, but over the last more than decade, I would say that the world has invested a lot in software, intellectual property, particularly in the developed markets like the U.S. Very little in property, plant, equipment. And I wonder, even with the Chinese internal policies having shifted over the last few years towards more consumption, building fewer car plants and things that are unneeded in the world, except for the local demands of the party there. And I think that internal consumption, coupled with the restrained demand we've had because of the pandemic and the lack of investment in these areas for more than a decade, is going to prove to be quite a supply shock, in my view. And therefore, the emerging markets should benefit from that.
John, final word, please.
No, I agree with that. I think two last point I would make is, I think there's an additional reason for emerging market, which is we are going into a more bifurcated world where that requires more deliberate allocation to other parts of the world, that you cannot get indirect exposure anymore as much. So I think this diversification argument is powerful and in favor of EM. And the last point on the weak dollar theme going forward, I think there's going to be a pressure point on the ECB that's going to come on this in the context where the Fed has done a very significant framework change. It raises question about whether the ECB should follow suit or not, and there's more noise around that, I think, building up.
Got a little clue from Ollie Rain recently, didn't we, in some comments he made. John, it's great to catch up. It's good to see you. Jean Bavin there of BlackRock. Ken Torbs joining us from Amundi. Ken, thank you. I want to turn now to the price action, all-time highs in the equity market. Up next, the analyst action you need to know. That'll be next in our morning calls. And later, the global recovery boosting commodity prices fueling a rally in the materials sector. That conversation's still ahead with Academy's Peter Cheer and Stifel's Barry Bannister.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
All-time highs in the equity market, stateside and in Europe too. In the bond market, yields 157. We had a massive gap lower on Friday, post-payrolls. What happened? It wasn't a demand story, we're told. 146 at the low end and then all the way back again, 157.54. That's the price action. Let's get you some morning calls this morning. A look at some of the analyst recommendations on Wall Street. We begin first up with Jefferies, with a big call upgrading Live Nation to a buy. An analyst highlighting the company's strengthening pipeline and concerts and sponsorships gaining momentum. Next up, Barclays downgrading Oracle to equal weight with an $80 price target. The analyst seeing limited potential for additional upside. That stock is down 1.75%. And Citi downgrading Facebook to neutral, 320 price target. The analyst warning investors of decelerating revenue growth stemming from digital advertising headwinds. Let's read the calls from the street. Your opening bell is up next with record highs on a table on the S&P 500. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, a Bloomberg exclusive conversation. Dallas Fed President Robert Kaplan joins Balance of Power live at noon Eastern on Bloomberg Television and Radio.
25 seconds away from the opening bell in New York City. Good morning to you all. We're shaping up as follows on the S&P. All-time highs on the S&P 500 at the close on Friday. We could add a little bit of weight to it. Up 3 on the S&P. We advance almost 0.1%. We are down on the Nasdaq, down 59 and off by 0.4%. There's the opening bell. Switch up the board and get into the bond market. We've talked about that range. That intraday range on Friday was just huge. Right now, 156.83, a really narrow trading range at about 157 on 10s. Look out the FX market, euro dollar a snooze compared to what's happening elsewhere. 121.74 on euro dollar. We advance 0.1%. Cable through 141. It is very much a political story, supporting or at least taking away the support for the push forward of a Scottish referendum. Sterling with a little bit of a relief rally. The Aussie getting a nice bounce too off the back of what? A surge in the commodity market. Iron ore, copper, crude, pick your commodity. It's got some green on it, up 0.8% on WTI to 65.40. That's the cross-asset story with the movers at the market desk. Here's Abby.
John, well, we do have an all-time high, as you were mentioning, for the S&P 500. Not helping right now, though, is the FANG trade. You were just mentioning that Facebook was cut at Citi to a neutral. That's true, too, for Alphabet, on the analyst concern that there could be some caution, reason for caution around ads. So both Facebook and Alphabet are down on that Citi downgrade to a neutral from a buy. Amazon, of course, big news this morning. They are offering an 8-part U.S. bond offering, the first in a year, to refinance debt and buy back stock. Those shares are down modestly, and then Netflix down as well. So big tech mega caps are lower. However, where we have strength, where we always have strength recently, metals and miners. This, of course, is we have copper close to $11,000 in London trading. Aluminum is up more than 1% with copper. Iron ore and steel both up more than 5%. So this commodity surge, it absolutely continues, helping out the inflation debate. Is this too many dollars chasing too few assets? Or is there a lot of demand behind these huge gains, John?
Abby, thank you. Mentioning that Amazon offering 8-part, multi-tranche, 2s all the way out to 40s. And just to give you an idea of the price, the reporting from Molly Smith of the team here at Bloomberg, 115 basis points over Treasuries for the 40-year piece of that debt offering. That sale kicking off right now. Let's get you the broader story for commodities. It's shaping up as follows. We're moving higher. Here's Kaylee Lines for more. Hey, Kaylee.
Well, John, as commodities move higher, so too does the materials sector. We have really seen the Bloomberg Commodity Index, as it's rallied to its highest since 2015, take the materials sector along with it. And on Friday, it closed at a record high. Of course, the boom in prices we are seeing in some of the industrial metals in particular really aiding the mining and steelmaking stocks within that index. So where we sit on a quarter-to-date basis is materials is your big outperformer. It's up 11.5% over the period, outpacing the likes of other cyclical and value plays like energy and financials, and of course, handily outpacing the broader market, which is up just 6.5%. And actually on Friday, the materials index closed at its highest relative to the benchmark, going all the way back to 2018. Now, as far as what the earnings story looks like for the materials sector, John, our Bloomberg Intelligence team here in-house says that they should actually outpace the profit growth of the broader market through 2021. But they said guidance is really going to be important going forward because as we move into mid-cycle, they could actually start to lag behind. So that is something to keep in mind as we see a divergence in the premium you have to pay for material stocks relative to the broader market. They are, of course, cheaper, a forward PE multiple of just around 20, John.
Kelly, thank you. Let's bring in a team. Academy's Peter Cheer and Stifel's Barry Bannister. Barry, let's not bury the lead. You're looking for a pullback here. Why?
Well, when you think about it, the taper, when it comes, and it's coming, is possibly going to cause higher real and nominal yields, and that will affect the market valuation. You also might see more than just mild and transitory inflation. The second half earnings are going to be discounted by mid-year. And the second half earnings are going to decelerate, obviously, from the very easy comparisons. And then I actually think there might be a little COVID bump in the summer. People tend to go inside, particularly in the southern states. And anyone who's vaccine hesitant is probably going to be convinced after that bump to get the shot. So you look at it, it's going to be a pullback, I think, of about 10%, but probably not more with the Fed doing all this QE, which is supporting the market.
Year-end price target 3,800 over at Stifel. Barry, one of the bearish out there. It didn't start that way, of course, because when these price targets came out, the S&P 500 was not where it is right now. We've seen huge moves, Peter Cheer, over the last 6 months. And Barry pointing out in his research, we've front-loaded some huge returns from November into May. Pete, when I spoke to Rick Reeder of BlackRock on this program last Friday, he was talking about running a bigger cash position, somewhere in the mid-teens across some of the portfolios, going into what could be a choppier summer. Does that resonate with you, Pete?
Yes, I do agree that we're going to see higher yields, steeper yield curves, and that's going to put pressure on some segments of the market. I'm really thinking, we probably talked about this before. This is going to be a stock pickers type market where you need to identify the right sectors who are going to benefit from where the economy is going to be 6 months from now, a year from now. And I think we also have to really think closely about where are the tax hikes going to come? Who's going to be impacted? What sectors should you avoid? So right now, I agree that we could see a 5 to 10% pullback, probably led by big tech. I think you're going to see other sectors like the commodity sectors continue to do very well as people get this real sense that this is a global reopening, global inflation trade, and there's a lot of potential growth, especially with long-term fiscal stimulus kicking in the U.S.
Pete, you're quite bullish inflation. Why? What's different about the circumstances now that changed the economic debate for you?
No, I think there's a couple things. One is I think we are starting to see wage inflation. When we look at Friday's economic data, you look at a lot of other data, the total jobs weren't attractive, but the number of job openings are high. And these are a lot of low-skilled job openings. So it's not a mismatch between skills and what employers are looking for. It's about not willing to work at a certain price. And I think that salary is going to come up because companies are going to realize they're missing an opportunity cost. And then I really do believe the shift towards sustainability is going to be inflationary. Companies are heavily incentivized to switch how they produce things. They're going to switch their products to be more sustainable, and they're going to be able to pass on that increased cost to consumers for the most part, and the other part will be able to be absorbed because their stocks will trade at a higher PE because of this ESG investing. So I think those are two things that are very, very different than we've seen any time over the last 10 years, and that's going to drive inflation much higher for longer.
Arguably, that's what we've seen in the copper price over the last several months too. Barry, I'd love your thoughts on a couple of pieces of that argument. One being the labour supply story. The shortages we have across this economy right now, some of, not all of them, can be addressed with higher prices. Do you think the labour market is one of those issues that will be addressed with higher prices, higher wages?
Clearly, I don't see a wage price spiral, but I think that there are some areas where there are skills mismatch. Also, you have school closures, which have been extensive and unnecessary in many ways, that have kept some parents at home. And then lastly, you do have some incentives not to work, but that's spotty. So all in all, I think it's going to require a higher price to clear the labor market, and that might get passed through, or it might compress margins, making that 32 times multiple on normalized operating earnings, 10-year average inflation-adjusted real operating earnings, more unsustainable. There's a lot of cognitive dissonance in the market. A high PE is going to require a long-term view, but the policies that support the high PE aren't viable long-term. So we have some problems with the market valuation and the inflation outlook.
And one of those policies that supports the higher PE, Barry, and you're pushing against right now is yield repression, I get my words out. Barry, what is it about policy that you're anticipating? How do you think it will evolve in the summer that's going to lead to yields going the other way?
QE is increasingly counterproductive, not just in the pricing at the short end, but also for bank lending and creation of reserves. We want lending. We don't want the Fed creating reserves. So the Fed is trapped by its own easy policies due to the political climate in Washington. You know, we have a somewhat radical Keynesian MMT-funded populism right now, and the Fed is trapped in that. It can't afford to give up its independence, but can't afford to fight it too hard. So they're really between a rock and a hard place. So I would think that you would have to have some phase back of the Fed's QE before the market would adjust lower.
Really interested in that word radical. That's a political assessment of what's happening in DC right now. But Peter, looking at the market, I don't see anything radical about the bond market, 157 on 10s. And the number one question we asked last week going into that payrolls report, you take out Friday, the only question that I heard anyone ask in the bond market was, data's great, why aren't yields higher? Pete, what was your reaction?
I think right now everyone's focused on when the Fed will hike. And I think they're not going to hike anytime soon. I think what we have to start talking about is the terminal rate. How high will yields have to go to slow down inflation once they let it out? That's a conversation that's going to take place over the coming weeks or months. And also, while there's talk about them tapering, I think there's also a risk that they do an operation twist. They do something to suppress that long end of the yield curve. So we're in a very micromanaged yield environment where the Fed is looking very closely at it. So I think people got very short, they got caught, and now we have to be cautious that the Fed doesn't fight this yield or move to higher yields, but I do think we get it. I'm expecting the 10-year to hit 2% this quarter.
Just south of 160 right now. Pete, stick with us. I want to lean on some of the expertise of the generals over at Academy and talk about this Colonial Pipeline shutdown. Barry Bannister, thank you, sir. Barry Bannister there at Stifel, catching up on this market. All-time highs on the equity market. Barry looking for a 5 to 10% pullback through the summer. For more at the market desk, here's Abby.
John, well, there's a strong reflationary tone this morning. Two of the best sectors, energy and materials. Starting out with materials, we've already looked at copper and iron and the metals and mining stocks on the industrial side. Now let's look at the gold mining stocks, because gold is having a stealth rally up for a fourth day in a row, the longest winning streak in 3 months, at its highest level since early February. This as the dollar is down, so gold is higher. If above the 200-day moving average, flirting with that level, the rally may just continue. Now turning to that pipeline story, we do have the shares of other pipeline companies, publicly traded pipeline companies, Kinder Morgan and Williams trading higher, along with some of the E&P companies, Apache and Devon, both up well more than 3.5%. That's, of course, on that story that broke over the weekend that Colonial Pipeline was hacked and that the nation's largest pipeline is now down for a third day. So a nice rally there for the energy sector, and that is the top sector on the morning, John.
One of the most talked about stories over the weekend, too. Abby, thank you. Coming up, one of the largest pipelines in the United States shutting down. We'll get the political reaction and the market response as well. Equities down 6 points on the S&P. We decline a little more than 0.1%. We pull back from all-time highs this Monday morning. Good morning. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There is renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
On Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
it's a top priority for the administration. Unfortunately, these sorts of attacks are becoming more frequent. They're here to stay, and we have to work in partnership with business to secure networks to defend ourselves against these attacks.
The White House pulling together a task force addressing the pipeline breach. Commodity prices surging amid supply constraints, with gasoline prices touching fresh three-year highs. For more, I want to bring in Emily Wilkins in D.C. and Kelly Lyons as well. Emily, let's just start right here. The debate down in Washington regarding this, what does it sound like?
So at this point, lawmakers are still starting to weigh in on this since it is developing over the weekend. But as you noted, the White House jumped on this pretty quickly with a task force that they want to not only investigate how the cybersecurity breach happened, but also make sure that the markets are not hurt by the stoppage of oil from this pipeline. Also looking to Congress to see what they might need to do. We've already heard from Congresswoman Yvette Clarke. She is the chair of the House Subcommittee on Cybersecurity. She noted that President Biden's infrastructure plan does not include anything specific on cybersecurity for infrastructure, but she said she wants to make sure that as the bill gets written by Congress, that there are cybersecurity items in it.
It is going to make Wednesday's meeting between the president and the Democratic and Republican leaders just a little bit more interesting. Emily Wilkins down in D.C. Emily, thank you. Kelly Lyons looking at the price action, the moves, pretty obvious, Kaylee.
Yeah, they are, John. I would say they were more obvious earlier on. Actually, now gasoline futures were up 4% at one point. Right now, they're only higher by about 0.7%. And even WTI crude has now actually flipped down on the day. We're trading below $65 a barrel as the market really tries to digest how much this pipeline closure is going to matter at the end of the day. A lot of that's going to depend on how long it lasts. But this isn't even the most exciting price action in the commodity complex today, John. Really, that was in the industrial metals. Overnight in Singapore, iron ore hitting a record high and copper hitting a record high on the London Metal Exchange as well. When you put together the rally we have seen in the industrial metals over the last year, the Bloomberg Industrial Metals Index is up the better part of 70%. Now, part of this is the broader narrative about the economic recovery, the demand that will come with it, and of course, dovish central banks, Goldman Sachs calling that a Goldilocks scenario. But there are more idiosyncratic factors here as well, one of them being China and stricter potential environmental regulations. That's giving a lift to both iron and copper. And of course, copper has the whole green transition narrative behind it as well. So when you put together what we're seeing in the industrial metals, what we're seeing in oil, what we're seeing even in the ags, the Bloomberg Commodity Index is at its highest since 2015. And the rally has brought the index into incredibly overbought levels. The 14-day RSI now at 84. Of course, 70 is what indicates the technically overbought threshold. So that could indicate some downside is to come, John, especially when you look at the fact that the 14-day RSI on the S&P 500 is only at 65, and it is very rare that these two diverge. So the question is when and how may they come back together, John?
Kelly Lyons, thank you. A couple of pieces here in the commodity market. Let's bring in Peter Cheer for one of them. This was Pete's quote in his research this morning off the back of all of this. We are vulnerable to cyber, and cyber can transfer digital risks into real-world consequences. Peter, was excited to have you with us this morning because I know the team over at Academy is made up by former generals, people with military experience. Can you walk me through the framework that you and the team have established to really think about these issues?
And a couple of our generals really do have a lot of experience directly with cyber. They set up U.S. Army Cyber. And I think there's a couple things that we wind up talking about a lot. One is that a lot of this comes down to the weakest link. Within each company, it's always the weakest link who left their password unprotected. It also comes down to within an industry, right? Where is that weakest link? How can that be exploited? And we talk a lot about, cyber being a domain of war. And if you think about other domains of war, whether it's air, sea, land, space, there's definitions, there's rules of engagement. Everyone knows what they're allowed to do, what they're not allowed to do. That gets very gray area in cyber. And as you see in this attack, it's likely a criminal enterprise, but in conjunction with a national enterprise. So I think we're going to have to do a lot of thinking on our side, how to get industry groups to work with government to really have a solid defense against this.
Is this an event that I should prepare my portfolio in anticipation of, or an event that I should be planning a game plan, a plan of action in response to?
No, I think it's something we've got to be